just because the market is being resilient doesn't mean that the risk isn't going to come back and bite it later.
Market and energy traders are still trying to understand what is the calculus here.
It would take some time for markets to get more confidence in the base case outlook for disruption.
There's a lot of uncertainty, but there's absolutely no volatility.
The market will respond when the circumstances change, either for the better or for the worse.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, crude back in the 60s. The Middle East avoiding the worst case scenario, sending crude oil even lower as Iranian retaliation is limited, orchestrated and very well telegraphed. President Trump is now heading to a NATO summit after securing a fragile truce, and that truce is looking shaky already.
Yeah, earlier this morning, there was this agreement for 4 a.m. Eastern time for there to be no missiles lobbed between Israel and Iran. A little after 4 a.m. or a little before, depending on how you look at it, Israel accused Iran of launching missiles at northern Israel, which they did intercept. There were sirens going off. And now Israeli Defense Minister Israel Katz coming out and saying, in light of this violation, I have instructed the IDF, in coordination with the Prime Minister, to continue the intense activity of attacking Tehran.
I think the market can handle that. Contained Israel-Iran skirmishes. What it cannot handle was the prospect of a broader escalation that involved the United States and a retaliation from Iran that would suck the US back in. We've avoided that. That's why crude has gone from the 80s to start the week and down into the 60s this morning.
The past 48 hours is a perfect example of why this market is benumbed to headline risk. You are looking at markets that have gotten whipsawed and beaten up every time they have tried to react in some sort of equal measure to the drama of the headlines that we have gotten day after day. And this is the reason why people are getting increasingly hesitant to make bold moves on any of these proclamations. How do you price in long-term oil spikes when they last all of a week?
Expecting some drama down on Capitol Hill later on this morning. Look out for Chairman Powell kicking off 2 days of testimony. This from the President of the United States going into that, saying the following: I hope Congress really works this very dumb, hard-headed person over. So you've got a lot to look forward to a little bit later this morning.
Yeah, and he goes on to say, and by the way, this was at 1:32 a.m. Eastern time that President Trump was truth socialing overnight. When does this guy sleep? I don't know. And this is what was on his mind. Then he could move on from the truce that you got between Iran and Israel. He said the board should activate Make America Great Again, the board, increasing focus on individual Fed members after yesterday Michelle Bowman, a Fed governor, reiterated what we heard from Chris Waller, saying that she would be open to a July rate cut if some of the inflation data continued to come in a decelerating path.
If you were looking to take the summer off, Fed watchers out there, maybe July starts to get a little bit more interesting. This morning, yields are lower again at the front end. We're down by 2 or 3 basis points. The 2-year, 3.83. Coming up this hour, we'll catch up with Geoffrey of BMY as a risk-on mood returns to markets. Edward Fishman of Columbia University on a fragile truce in the Middle East. And Congressman French Hill as Fed Chair Jay Powell heads to Capitol Hill. We begin this hour with our top story, a fragile truce in the Middle East. Our team coverage starts right now with Annmarie from the NATO summit and Bloomberg's Jemana Bassechi in Dubai. Jemana, let's turn to you first. The president declaring, announcing a ceasefire. Who's signed up to it?
Yeah, well, a lot of developments have happened in the last 12 hours. It's really been a whirlwind over here in the region. But as you say, around 2 a.m. local time, President Trump put out that Truth Social post declaring and announcing the ceasefire, the bilateral ceasefire, and that it had been agreed to between Iran and Israel. Now, the timeline was a bit ambiguous because it wasn't until about 8 hours later that we got an official comment from Israel, the Prime Minister's office, putting out a statement saying that they had actually agreed to the terms of the ceasefire as put forward by the United States, and also adding that they had achieved their war objectives in Iran. Now, we're expecting to hear from the Israeli Prime Minister later today. He's expected to deliver remarks. But it took us a couple of hours after that to even hear from the Iranian side. And in the interim, a barrage of missiles kept being directed towards Israel. And in fact, it resulted in the death of 4 people per the latest figures. And questions really about what time Iran sent those missiles towards Israel, whether they had actually violated the ceasefire. The latest being that the Israeli defense minister has deemed it a violation of the truce and has instructed the IDF to act on that. So we will likely get a response to that particular episode, but it is also worth pointing out that Iran, the National Security Council, did issue a statement tacitly acknowledging the existence of a ceasefire, saying they affirmed the national decision to impose a cessation of war. They're framing it as a victory. So the world is taking it as they're sort of signing on to the ceasefire without explicitly saying it. So net, we're in a situation now where it is fair to say that there is a ceasefire. There have been, appears to be a couple of violations this morning, but ultimately the region is breathing a sigh of relief because we didn't get the broader escalation that perhaps could have been forthcoming 24 hours ago.
We certainly avoided the worst case scenario in the region, that's for sure. The president now heads to a NATO summit in Europe. Annmarie, does he head to Europe with increased confidence?
Absolutely. The president is going to come here and also, I think, look some naysayers in the eye, like Emmanuel Macron, Jonathan, who last week at the G7, he was also irked by him when Macron said that he was going back to Washington to strike the ceasefire agreement. And the president went on Truth and said that is, quote, wrong, and said he has no idea why I'm going back to Washington. It's going to be much bigger than that. In the end, the president is saying that he has a ceasefire. But of course, that came after a massive strike over the weekend on Iran's nuclear facilities. We also had Emmanuel Macron come out yesterday in Europe talking about the fact that he thinks what the United States did in terms of these strikes is illegal. So the president is going to come in here and maybe get along with individuals like the German chancellor, who said that what Israel and the United States is doing is the dirty work. And why should I criticize what they're doing if they're taking out Iran's nuclear capabilities? The ceasefire is fragile, as Jumana just went through, especially what is going on with the Israeli defense minister saying that the IDF will respond. But at the same time, if this is the start of the end of this mini conflict that did not spill out into a wider, protracted war, the president is going to come into this NATO conference and say, you have to escalate to de-escalate, and he's going to look back on past experiences like 2020 when it came to Qasem Soleimani, this experience this year, and he is going to use that probably as leverage to get more European allies to join him in his mythology, as well as increasing their defense spending, which he has been complaining about to the European Union for years.
Annmarie, Jumana, the Bloomberg team, more from them later on in the programme. For a snapshot of what's happening in the market right now, equity futures positive by 0.5% on the S&P. Crude rolling over once again. Here's the view on Wall Street this morning. Geoffrey of BNY writing the following: investors have to consider many conflicting factors, from inflation to growth linked to oil prices, tariffs, taxes and deregulation. Jeff joins us now for more. Jeff, good morning, sir. Are we bullish enough? Max Kettner, HSBC. We think the biggest risk to our view is that we're not bullish enough. Jeff, it just feels like this market's Teflon. What's your view on some of the moves we've seen more recently?
Well, just to paraphrase Annmarie there, it seems to be you need to be risk off to be back to risk on, right? But if markets are inured to this, then why bother being risk off in the first place? And looking at our flow data, you know, how the dollar's been performing. Let me tell you this, last Wednesday, FOMC day, IMM day, was the biggest volume date we had year to date. But the net direction was flat. Flat for dollars, pretty flat for everything else. So it just shows you people don't want to take too much conviction on right now, but if the direction's going to be risk on, then you just can't afford not to participate.
A couple of weeks ago, Jeff, some investors were saying that the pain trade was further gains in the S&P 500 and U.S. equities. Do you still see that as being the case in some of the positioning data that you would look at?
So looking at equity data right now, so absolutely yes for European equities. And if we're heading into the NATO summit, you're looking for further defence spend. This is a market that, based on our data, is over 50% positioned above last year's average. So normally you would not want to add to that kind of positioning. But if you do get a above expectations spend commitment out of the EU, then that may go high. For the US market, you know, not so much yet, because we haven't really fulfilled that positioning gap opened up after Liberation Day. But if we do surpass that over the coming weeks, then the pain trade could be looking somewhat problematic as well. For FX, it's another matter. I think the dollar from here can definitely go higher versus the euro, although be selective in that trade as well.
It was really great that we had both Jumana and AMH talking about the dual sides of some of the main stories this morning. On one hand, you've got the conflict between Iran and Israel that was stymied by a show of force. Then you have NATO discussions, excuse me, where President Trump is talking about how important it is to spend on the military. How much is there an upside risk in both growth and inflation from some of the spending that we're hearing a lot of the NATO members committing to as a result of some of the demands from President Trump?
So from the EU perspective, it really is about the quality of growth rather than the amount of growth. So again, going back to how our positioning is in industrials and aerospace and defence, it looks like markets are positioning for 1.5–2% European growth, right? Which sounds good, but you want to deliver that in real terms without too much inflation. So it's about the productivity gains. You know what the Draghi report signalled last year. I think from the US's point of view, again, it's about avoiding stagflation. If it is positive growth, moderation inflation, whereas keeping nominal growth in terms, and that translates into good households who can then spend and boost earnings, that's the important side of things. Are we there yet? Probably not. And to be honest, given all of these events, you accumulate them into weaker confidence. I'm still sceptical whether we can achieve that earnings growth which is being priced in.
Jeff, for Fed watchers out there, can we take the summer off? This from the Atlanta Fed President Raphael Bostic just moments ago to Reuters. No rush to cut rates with price hikes expected. Governor Bowman, Governor Waller disagree. They open the door to July. Jeff, what's your base case for this summer?
So this summer, our base case, no cuts, right? Wanting to roll that until September maybe and then go from there. Again, it's following the data. So I think every single Fed member that's motioned, towards cuts of late is still stressing that they want to look at the data first. So if the data justifies it, then you can move it forward. And I think that's why markets are somewhat cautious in pricing July in. But if we get a sudden turn, especially in inflation, then probably that will be the case as well. Maybe we move into a BOE-like scenario, where you have a few splits coming through and then just see, where the tiebreaker is. But certainly it does bring in some summer volatility along the Fed curve as well.
Jeff, we've had a string of downside surprises on core inflation in America. Why do you take little comfort from that?
Well, again, it is really the direction of travel. So is it going to be a sustainable downside? We head back to target, then below target, and keep it there. So if then we do have downside growth surprises, then you can actually make a case for the Fed to move ahead of that. You want to really anticipate where the data is going to be. You don't want to be behind the curve. Are we in a position where you can see data undershoot, core inflation and headline inflation undershoot? I don't think that's the case yet, especially, with the spending that is being mauled. And of course, we've got the fiscal considerations to talk about. Is the US moving towards fiscal consolidation? Probably not. And that's something that the Fed will have to consider. All central banks will need to consider the fiscal path right now. And I think that's helping the ECB stay where they are. But on the other hand, that's helping the BOE push towards a more cautious approach.
So, Jeff, that introduces an interesting calendar. July 4th. On July 4th, we're expecting that tax bill to pass. That's a self-imposed deadline. July 9th, we're expecting some kind of trade deal between the United States and a whole bunch of countries. How do you want to position into that calendar?
So you want to position for, I would say, risk. And risk insofar as the market has been totally inured to risk right now, we would probably take the other side of that. Have conviction first, and I think conviction will be maybe a repeat of what happened in April, not as aggressive, because the White House has seen that, but the tightening in financial conditions through some steepening in the curve, I think that is to be anticipated, because if you actually take the opposite side of what could go wrong, higher spending for one, and then you don't get the trade deals and tariffs come through, then that bear steepening comes into play. That is not risk positive, and I think markets still need to be attentive to that.
Hey, Jeff, appreciate your time. Jeff Yu there of BNY. That final point there, Lisa, on the bond market, an interesting one. The next 2 weeks, full of risk.
Suddenly, what happens on Friday is going to matter quite a bit, especially because of what Michelle Bowman said yesterday. The fact that if you get core PCE on Friday and some of the spending and income data from individuals in the United States that comes in lighter than expected, does this open the door more materially to a July rate cut? It is data dependent, but how much data is actually relevant to your point where we already have that data, but you can dismiss it as backward looking? When is it not backward looking anymore?
The bond yields this morning down by about a basis point. Crude continues to roll over. Equities at the moment just off session highs. We're doing better again. We're up by 0.5%. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. We start with the latest on the ceasefire. Israel accusing Iran of violating it and ordering strikes on Tehran. The news came out hours after President Trump announced an end to the 12-day war. At that point, Trump posted on social media, the ceasefire is now in effect. please do not violate it. The president is heading to NATO in The Hague this morning. Meanwhile, passengers on a Paris-bound Qantas flight spent more than 15 hours in the air, only to end up back where they started. The flight departed from Perth, Australia, making it into Indian airspace before an Iranian missile attack closed airspace in the region, forcing it to turn around. The plane landed safely back in Perth today around 11 a.m. local time. And Starbucks is disputing a report that it's thinking of selling its China business. Caixin Global reported the company held talks with over a dozen potential partners, including 2 private equity firms. But Starbucks says it's not considering a full sale. This coming as the brand struggles in China due to weak consumption and intense local competition. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, President Trump seeking a reset.
I think the president really hit the reset button and said, look, let's actually produce long-term peace for the region. That's always been his goal. I actually think when we look back, we will say the 12-day war was an important reset moment for the entire region.
Up next on the program, Edward Fishman of Columbia University, live from New York City this morning. Good morning. What a wild trip for crude. In just a couple of sessions, we started the week just north of the 80 mark on Brent crude. This morning, we're in the 60s, 69.37, as we avoid the worst case scenario across the region in the Middle East. Crude is down by another 3% this morning on both Brent and WTI. In the equity market, adding to yesterday's gains, equity futures up this morning on the S&P 500, positive by 0.8%. On the Nasdaq 100, up by close to 1 full percentage point. Out of surveillance this morning, President Trump seeking a reset.
A week ago, Iran was very close to having a nuclear weapon. Now, Iran is incapable of building a nuclear weapon with the equipment they have because we destroyed it. Our hope and our expectation is that they're not going to try to rebuild that program. And I think the president really hit the reset button and said, look, let's actually produce long-term peace for the region. That's always been his goal. I actually think when we look back, we will say the 12-day war was an important reset moment for the entire region.
So here's the latest this morning. A fragile truce between Israel and Iran being tested already. Israel accusing Iran of violating the ceasefire agreement and vowing to retaliate. Joining us now is Edward Fishman of Columbia University and former Russia and Europe sanctions lead at the U.S. State Department. Eddie, good morning. It's good to see you.
Yeah, nice to see you too, John.
The words of the Vice President, J.D. Vance, saying that I actually think that when we look back, we'll say the 12-day war was an important reset moment for the entire region. Do you agree?
Yes, of course, because this is a fundamental shift in terms of how U.S. policy and broader policy toward Iran has been for 20 years. For 20 years, we have all considered a nuclear-armed Iran as completely unacceptable. But up until a few days ago, that goal had been pursued by sanctions and diplomacy. And military force was held in reserve because the idea was that Iran may be pursuing a threshold nuclear capability, but that they would never weaponize if they knew that racing for the bomb would lead to U.S. and Israeli strikes. Well, we've now acted preventively. And so that whole reason for deterrence, the reason for Iran not to pursue weaponization, has been taken off the table. So what I would say is this is a very high risk, potentially high reward gamble. But again, the risk is quite acute right there.
It's a big question, and it warrants maybe a long answer. Have we established deterrence in the region or not?
Oof. I mean, look, deterrence against Iran, yes. I mean, I don't think that Iran is going to, strike the U.S. in an aggressive way. I think ultimately what Ayatollah Khamenei cares about most of all, even more than the nuclear program, is regime survival. And so that's why I never took seriously the idea that they would close the Strait of Hormuz or that they would aggressively attack U.S. forces, because I think he knows that's the end of his regime at that point. But in terms of whether it has ended the nuclear program, that I'm much more skeptical about, because while even if you can accept at face value the idea that the centrifuges at Fordo and Natanz have been destroyed, and I don't think anyone really knows because we don't have eyes inside those facilities, the 400 kilograms of high enriched uranium, enough for 10 bombs, is apparently missing on the loose. And even if Iran has a single covert nuclear facility, and that's something that no one knows, they could take that material and produce weapons-grade uranium in a matter of days. And so the thing I worry about is a situation where the bomb just sort of goes in the basement.
Which is the reason why some people are saying that maybe this is a step to push Iran to the table more aggressively in a way that they were unwilling to do so earlier. How feasible do you see that scenario as?
It's going to be really challenging because the Iranians are not going to want to be seen to capitulate to American force, right? And so I think diplomacy on the nuclear program for the next few months is going to be very challenging. However, what I think this does do is it does open up the possibility, at least, although however slim it may be, that you could get Iran to agree to something like no enrichment on their soil. Because if you've truly wiped out their enrichment capacity, which they've spent $500 billion to build over several decades, then maybe it's not as big of a concession for Iran to give. But I think the first step to that, and one that's going to be very challenging, is to establish a stable ceasefire between Israel and Iran, let tensions cool, and then maybe a few months down the road, pursue diplomacy.
At the same time, people are discussing the broader ramifications of this back and forth of this incursion and saying that actually it will be a deterrent for, say, other countries that are looking to test the United States, that are maybe thinking that the U.S. wouldn't use force, and now the fact that they did would offer some sort of deterrent. How feasible do you see that as sort of a presiding sentiment going forward?
That I fundamentally disagree with. I mean, look at the circumstances in which Trump intervened. Israel had established complete air superiority over Iran. Basically, Iran had no control over its skies, right? So Trump said, I thought it was kind of humorous, we control the skies over Iran. It was actually Israel that had established that. So yes, any country that doesn't have the ability to potentially shoot down American planes or that the U.S. doesn't fear retaliation from, yes, Trump will act. Whether that leads to more deterrence against China in the Taiwan Strait or against Russia, I'm much more skeptical.
Eddie, can we explore the counterfactual? Got a few moments. The Joint Comprehensive Plan of Action, JCPOA, signed back in 2015. You were part of the Iran sanctions team. This, of course, heavily favoured by the Democratic side of Washington, D.C., ripped up by the current President Donald Trump in his first term. Where would we be today in your mind if we hadn't ripped that up?
We'd be in a much better place. I think fundamentally, the only way you can end Iran's nuclear program is through a deal, right? Bombs can set back the nuclear program, but they can't end it. The JCPOA prevented Iran from having any high-enriched uranium. They only had 300 kilograms of low-enriched uranium. Today, they've got 400 kilograms of high-enriched uranium, right? So they're much closer to a bomb than they would be otherwise. The big critics of the JCPOA said that, well, this is time-limited. It's not indefinite. This critical component of limiting Iran's uranium enrichment would have expired in 2030, so 5 years from now. So what we've done, basically, is by ripping up the JCPOA, is I think it's set in motion the conditions that led to military force being on the table today.
This, of course, was something that was also favoured by the Europeans. The president heads to Europe now to meet for a NATO summit. How divided are the members of that NATO alliance now?
Extremely divided. I think, look, what has happened, and the thing that's really divided the NATO isn't so much Iran, right? It's Russia, in that NATO views, most of the members of NATO view Russia as an existential threat. Many of the members view Russia as a potential military threat that they could invade within the next few years. Trump has been wary of doing anything aggressive toward Russia, right? There have been 0 new sanctions on Putin put in place since the beginning of the year, and basically no willingness to actually stand up to the Russian threat. And that hasn't changed. And we've seen, I think one of the interesting things about your question on deterrence is, sure, Trump may not chicken out when it comes to bombing Iran, but with respect to Russia, we've seen 0 follow-through on any of the red lines or threats that he's put in place toward Putin.
Is that something you expect the Europeans to push him on this week?
Yes, I do. Because, again, this is existential for members of the European Union. At the same time, the European members of NATO really don't want Trump to fully walk away, right? Their big fear is that Trump could actually just turn his back on NATO and say, you know what, we're no longer going to abide by Article 5. We're not going to provide you defense in a time of need. And so there is this delicate balance that the members of NATO are having to play right now.
Eddie, it's good to see you.
Great
As
to see
always,
you.
appreciate your time. Thank you. Edwin Fishman there of Columbia University and also author of Choke Points. Check it out. Fantastic book. Lisa, that's the situation, some tension for the Europeans once again as the president pushes them to spend more on defence.
There seems to be an inconsistency when it comes to how some of the force is applied, and that's currently going to be one of the main topics as they commit to spending 5% of their GDPs.
Expect more coverage on the NATO summit with Annmarie. She's on the ground. We'll catch up with her in about 30 minutes' time. Up next on the programme, it is McFee of Oxford Economics on the risk to dollar dominance. Live from New York City this morning, you're watching Bloomberg TV. going to be a hot one in New York City, breaking into triple digits a little bit later on today. Going into all of that, equity futures positive again, up by 0.8% on the S&P, positive by 1 full percentage point on the Nasdaq 100. Stocks are flying later on this morning. Chairman Powell testimony, day one of two-day testimony on Capitol Hill. Look out for that a little bit later. We'll have a preview for you in just a moment. We're 3 hours away from the cash open. Let's get you some morning movers. Let's cross over to Danny Berger, who has more. Morning, Danny.
Good morning, John. A real sense of relief across airline stocks this morning, which have been punished over the past 12 days with the conflict in the Middle East. You can see United's up 3.5%. Delta's up more than 2%. One, because you have lower fuel prices and the hope that airspace reopens up over the Middle East and helps avoid some of the longer routes, or in the case of that Qantas flight, a 15-hour flight that gets you back where you started. Elsewhere, we are seeing Lyft shares. Those are rallying in the pre-market, too. Those are up 4.3%. An upgrade from TD Cowen this morning from hold to buy, saying that its expansion has gone beyond its top 25 markets. And with the acquisition of Free, now it's also entering into international markets, so likes the prospect of that growth. Now, elsewhere, stablecoin stocks have been on an absolute tear after the Senate bringing up legislation that would make stablecoins more mainstream this morning. It's another day of a rally from Fiserv. This is a stablecoin issuer, but this time joining in with MasterCard. MasterCard announcing moments ago that it will be seeking a joint venture with Fiserv to work on stablecoins. Of course, stablecoins are a real threat to the likes of MasterCard and Visa, so those shares up again this morning, John.
Danny, thank you. Can you imagine being trapped on a plane to nowhere for that long, that Qantas flight?
Honestly,
Brutal.
I don't think I want to, because the rage that I would feel, the frustration, the sadness, it's an emotional roller coaster that I don't feel like expressing.
Would you be one of those people who run up and down and start shouting at people and get caught on smartphones?
I would hope not, but I can't guarantee anything.
On our radar this morning, Israel accusing Iran of breaching a ceasefire just hours after President Trump announced the deal. Iran has yet to publicly confirm it agreed to a truce. That truce is already looking shaky, but this oil market is looking the other way. We've gone from the 80s to the 60s in about 24 hours.
People were seeing the potential for some sort of huge oil disruption, like the closure of the Strait of Hormuz. This seems to be taken off the table at this point. There haven't really been attacks even on oil infrastructure. There's been some conversation between the Gulf states. Don't you dare come and fire weapons on my territory kind of talk. And ultimately, people are saying that this will pass. Whether the conflict is over is quite another story, as we see from some of the Israeli response to missiles fired at them earlier this morning. And I think that that is going to be a longer discussion.
This was a crude story. The next story could be a bond market story, and it involves foreign relations, foreign policy and international relations. The president heading to the NATO summit today. European leaders planning to ramp up defence spending. They're expected to try to persuade Trump not to withdraw troops, weapons or military aid from the region.
So one question is what we were talking about with Eddie Fishman, which was, what is the U.S.'s role with Russia and Ukraine? The point that you raised about the bond market is going to be one that is very market sensitive, and a lot of people are looking at, especially as Germany put out some of its expectations for Q3 borrowing later this year. And it shows that they're going to be selling $22 billion in additional debt than they originally had planned to fund some of the infrastructure and military build out. The question is, are we underappreciating the amount of spending that European countries are going to be doing, and the U.S., frankly, by the way, because the OBBB isn't exactly contractionary? And how much does this actually spur growth versus just simply inflate the deficit?
This speaks to what Jeff Gundlach spoke to you about over at DoubleLine, which is the great reckoning he thinks is coming for the bond market at some point in the future.
Well, I asked him whether we are seeing the sort of prospect, I don't want to say of bankruptcy. He said bankruptcy. I'm not going to say bankruptcy, but some sort of fiscal pressure in the United States is getting true pushback by Treasury buyers. And he said, you're already seeing this. And he pointed to some of the disruptions that we've seen in the fact that Treasuries have not acted as that haven bid. It is a complicated story, because what is the risk? Is it inflation or is it deteriorating growth? And because we don't understand that, it's not a clean read, but this is an increasing discussion as we head toward the July 4th deadline.
We'll catch up with DoubleLine in the next hour, so look out for that conversation on the bond market. Also look out for this. Fed Chair Jay Powell testifying to Congress this week. President Trump attacking the Fed Chair once again, up late overnight posting this, saying that, quote, I hope Congress really works this very dumb, hard-headed person over. So that's your setup for later on this morning.
And it just continues the job owning. Will it be effective? And is it already being effective? And that, I think, is the increasing question. Jim Bianco of Bianco Research put out a note yesterday where he said, are we witnessing the beginning of a Fed mutiny led by two Trump appointees, talking about Michelle Bowman as well as Chris Waller, opening the prospect of a July rate cut? We can get into that later. But there clearly are some people who are listening to what President Trump is saying, and some people who would argue that is the correct economic point of view. So this is a complicated discussion beyond just saying political pressure.
Matt Lazzetti, Deutsche Bank. The June SEP was more about division than uncertainty. Speaks to that. The chairman wanted to sit in the news conference and say it's very uncertain. He, of course, doesn't want to come out and say we're very divided, but a lot of people are starting to conclude that's precisely what they are.
Do we get dissent in July? This might be the big question for that meeting that does come at the end of July.
And what does this mean for the FX market and the US dollar? Innes McFee of Oxford Economics writing the following. Although the near-term challenges to the dollar's dominance have risen recently, we think they're still relatively limited compared to the seismic shift needed for the global economy to switch to another principal currency. Innes joins us now for more. Innes, welcome to New York. It's good to see you.
Thanks, John.
Let's get to this call. Why are you a little bit more constructive on the dollar, at least from this perspective?
Well, I think, John, what we're seeing is a lot of cyclical pressure on the dollar. Clearly, the impacts of tariffs and now oil as well is sort of stagflationary at the margin for the US, whereas it's more straightforwardly disinflationary for the US. At the same time, investors all around the world have been very much overweight US assets, and there's a little bit of a point at which now they're sort of, given this shock, they're reassessing that and maybe doing a bit more hedging. And then thirdly, of course, there's a lot of uncertainty, not just about tariffs, but about fiscal policy as well and what that means for yields and the term premium. So, you know, to me, a lot of that cyclical pressure is a reason why the dollar's depreciating. It's down more than 10% against the major floating currencies. But that doesn't necessarily mean that we're going to see some broader reassessment. At the end of the day, the US remains the largest market. It remains absolutely central to the global trading system. And at the same time, you know, what we're going to see is really big long-term shifts to see that the dollar are no longer part of that major system.
Long-term is the right term. This is a long-term conversation, much more short-term. If we can turn to the calendar, July 4th, we've got this self-imposed deadline for the tax bill. July 9th, we've got this other self-imposed deadline for a whole host of tax deals, trade deals. I just wonder, from your perspective, being in London, looking over to the United States, how you think about the next few weeks and how things shake out.
Well, I think, you know, the market's pretty much on pause to see a lot of these deadlines come through. As ever, the market kind of thinks that, you know, a couple of weeks down the line we'll get more clarity. Clearly we might not, though. And if we don't, then that's clearly going to be another catalyst for the dollar to move a leg down, perhaps.
How much are we seeing the dollar weaken as a result of some of the fiscal spending and potential inflationary impacts? I mean, this has been one of the arguments that people have been making. The fiscal backdrop is one reason why the U.S. is losing fiscal dominance. Does that have relevance at a time where there's fiscal expansion in Europe as well?
I think it does have relevance, but it is within that broader context. I think, if you like, everyone's been very focused on US fiscal policy at the moment. We're starting to see a little bit more clarity from Europe in terms of what will come. At the end of the day, I think it's actually broader than that. We're obviously seeing a lot more issuance. The net supply of safe assets, which has been so low for the last decade, is rising and rising very substantially. But at the same time, we're also seeing a lot of macroeconomic volatility. Fiscal policy has changed from being very passive the last 10 years to being an active tool of demand management. And that does have implications for the term premium. Term premium should rise. We should see yields higher, even regardless of where short-term rates are going.
Taking a step back, for the bulk of this year, there's been sort of a pendulum that's been swinging between the risks of either inflation accelerating on the heels of some of the supply shocks, fiscal expenditures, versus some sort of downgrade to growth that we've seen from tariffs, from some of these disruptions, from even the oil shock and what that does to consumers. What have we learned over the past 48 hours about what people's expectations and their response to a potential oil shock or inflationary shock would be? Do we have a greater sense that the inflation upside is kind of being reduced somewhat?
Well, I think, as you said earlier on, you know, the Fed's very divided on this issue. Clearly, what we've learned over the last 48 hours is that the market has kind of almost gone to price in a risk premium on oil that's pretty much where we were in the middle of June. So there's a lot of upside to that, I would argue, given that this already seems to be a very fragile ceasefire. But fundamentally, you know, there are those that will want to ease early, and that's a very defensible attitude, given that we know that increase in oil prices will have a detrimental impact to growth later on and bring inflation down eventually. But remember where we've just come from. The Fed and other central banks have just seen a huge inflation overshoot in recent years. We're not confident as economists, as central banks at the moment, about the second round impacts from an increase in inflation. And I think, it's a very defensible attitude to want to wait and see how big that impact on prices will be, and therefore what the second round impacts will be. We haven't even seen or even started to see the big upside to the initial inflation shock, let alone what that might do for second round impacts.
With all of that in mind, do you think July is a live meeting?
I don't. We've long said that December is going to be when they cut. There are good reasons for that. I think we may well see dissents. We've seen dissents, though, under Chair Powell before. I don't think that's necessarily a deal breaker. I just don't think we're going to get clarity over the data that's going to move the majority of the committee towards wanting to cut.
Looking for some clarity from the Fed chair a little bit later on this morning. It's McFee of Oxford Economics. It's good to see you. Thanks for dropping by and enjoy New York. Looking for some clarity on the issue over in the Middle East as well. The President of the United States announcing a ceasefire between Israel and Iran. Asked by reporters before leading to the NATO summit whether that ceasefire, that truce is breaking. The President saying, Lisa, just moments ago, I don't think so.
Yeah, and this really goes to the heart of the lack of clarity. President Trump, when asked about the ceasefire, saying, I think they both violated it. So where does that leave us? Him saying, get that ceasefire together, guys. We have to have this sort of the de facto place where we're going to launch off as he heads to NATO and as they get a sense of some sort of calming down in the oil market. Just yesterday, he came out. Guys, don't bid up the price of oil. That's just letting them win. So today, he got what he wanted.
Crude is down nicely by 2.9% on both Brent and WTI. The latest from the president there. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Arnold. Hey, Yahara.
Hi, John. Senate Republicans are coming around to the $40,000 SALT cap proposed by the House in the president's tax cut package, but they want to lower the income threshold. The SALT provision is one of several holdups for the bill. Other issues include Medicaid cuts and green energy tax credits. Republican leaders hope to pass the bill by President Trump's deadline of July 4th. And Amazon has unveiled a $54 billion plan for investment in the UK over the next 3 years. The online shopping giant will open 4 new warehouses, creating thousands of new jobs nationwide. UK Prime Minister Keir Starmer called it a massive vote of confidence in the UK as the best place to do business. And NVIDIA CEO Jensen Huang sold over $14 million of NVIDIA stock over 2 days. It's his first transactions under a plan allowing him to raise cash without spooking investors. According to the Bloomberg Billionaires Index, Huang is the world's 12th richest person, but his fortune is almost entirely made up of NVIDIA stock. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the program, a dovish tilt from the Fed.
It is time to consider adjusting the policy rate. Should inflation pressures remain contained, I would support lowering the policy rate as soon as our next meeting.
Another call for an interest rate cut from another governor on the FOMC. Up next, the chair of the House Finance Committee, Congressman French Hill, who will be leading the conversation with the chairman of the Federal Reserve later on this morning. Live from New York, this is Bloomberg. Live from New York City this morning. Good morning to you all. The president making his way towards a NATO summit over in Europe. Just stopping by some reporters and answering some questions. Asked about the truce between Iran and Israel breaking, saying, I don't think so. Going on to say this about the ceasefire, though, I think they both violated it. I'm not happy with Israel. I'm not happy with Iran either. I'm really not happy with Israel going out earlier on this morning. This is still relevant for foreign policy. It is increasingly less relevant for financial markets. And you can see that in today's price action. Equity futures positive once again by 0.8% on the Nasdaq, up by 1 full percentage point. Crude, what a round trip we've been on from the 80s back to the 60s on Brent. 69.36 and down 3% on the session. Under surveillance this morning, a dovish tilt from the Federal Reserve.
As we think about the path forward, it is time to consider adjusting the policy rate. Should inflation pressures remain contained, I would support lowering the policy rate as soon as our next meeting in order to bring it closer to its neutral setting and to sustain a healthy labor market.
It's the latest this morning. Fed Governor Michelle Bowman joining Chris Waller with support for a July rate cut. The comments coming ahead of Fed Chair Jay Powell's two-day testimony on Capitol Hill as President Trump continues slamming Chair Powell for holding interest rates. Bloomberg's Mike McKee joins us now from D.C. with more. Good morning, Mike.
Good morning, John. Well, I would certainly expect right from the top that Jay Powell will be a lot more polite in addressing these questions than Donald Trump is in posing them. But I don't think Powell is going to sound very dovish today. Michelle Bowman and Chris Waller have both come out in favor of perhaps lowering interest rates as soon as July. But both of them are also the Republican members who were appointed by Donald Trump. Other members of the Open Market Committee have been much more circumspect about when they'll be able to get around to it. Reuters this morning reporting in an interview with Raphael Bostic, the Atlanta Fed president, that he still sees just one rate cut by the end of the year. So not everybody is on board with their thinking. They just get a lot of publicity because they're the first ones to say it. Not sure how much influence Bowman has on monetary policy. She's the banking person, but she did create a lot of news yesterday in saying that basically she wants to dial back the supplementary leverage ratio, something that Wall Street banks have been waiting for quite some time. Maybe that has more of an impact on certain stocks than Jay Powell today.
Let's see if that comes up in the hearings over the next 2 days. Mike, we'll catch up with you later. Mike McKee there down in Washington, D.C. Joining us now is the Congressman French Hill of Arkansas, chairman of the House Financial Services Committee, which the Fed chair will be testifying before later on today. Congressman, welcome back to the programme, sir. Always good to hear from you. I'm going to start with a slightly provocative question. I'm paraphrasing here. Do you plan to work over this very dumb, hard-headed person a little bit later this morning?
Well, Jonathan, it's great to be with you. We look forward to having Chair Powell before the committee this morning. And I think he'll face questions on his outlook for inflation and therefore what his views are about rate cuts coming forward. I think that's the important issue of the day. But he'll also probably be complimented by members because the Fed has recently taken decisions to get out of some of the environmental social governance groups that they were involved in around climate change, something that House Republicans have never thought the Fed should be involved in over the past few years. We want them focused on price stability, number one, and number two, we want them focused on a safe and sound banking system. We thought that was a distraction.
So we've got monetary policy and then we've got bank regulation. So, Congressman, let's start with the monetary policy first. As you're aware, and as I implied with that first question, the White House is really ramping up the pressure on the Fed chair. Do you worry that the chair starts to become more worried about the optics of cutting interest rates than focused on the data that might justify them?
I really don't, Jonathan, because since World War II, we've seen pressure from presidents on Fed chairs, but we've seen the Fed chairs and the Board of Governors try to be data-driven in their decisions. And, of course, they've made mistakes over that period of time, which is while the Fed is a creation of Congress and I believe strongly in an independent monetary policy, it's also true to recognize that they're not immune from criticism. So there's a debate, and you've already seen that debate shaping on the Open Market Committee itself with the comments from Governor Waller and Governor Bowman.
Congressman, would you be willing or would you support the idea of nominating someone to be the next Fed chair soon so that they can have an outsized influence over the committee?
I think it's my, base case assumption that Chairman Powell will serve out his term and President Trump will make a determination on who he thinks should be the next chair at that time.
Well, just the reason why I ask this is because some people have speculated that that's what's going to happen. We have heard from this administration that they are going to consider potential future candidates. And there's a lot of speculation that Chris Waller and Michelle Bowman are kind of in the running and trying out. I mean, how much would you like to see some of this noise taken away from the real debate, which is what is the predominant risk to markets? Is it potential weakening or is it inflation?
Well, again, as I say, I think certainly since World War II, the speculation about how presidents feel about their Fed chairs and who they might nominate to succeed a Fed chair has just been part of the markets, and the markets understand that. What's important is that the Fed gets it right and we focus on price stability. And if the inflation forecast and inflation expectations are anchored at that 2% level, then I think that's certainly something the Fed should take into strong consideration about a rate cut in the coming meetings. And that's exactly the kind of work I want them to do, is use data analytics, look at the trends in the market, look at their forecast, and make that decision to the best of their ability.
And many of those officials are focused on the policy outcomes of other things. July 4th, we've got the self-imposed deadline to pass the One Big Beautiful Bill. July 9th, another self-imposed deadline to come to some kind of trade deal with a whole bunch of countries. Congressman, could you maybe help the Fed chair a little bit later this morning? Where do you think we will be in a few weeks' time?
Well, look, I think uncertainty is a part of life. It's a part of the stock market and the bond markets every single day. But if I look back at the 1980s, we had extraordinarily high inflation. We had high budget deficits for the time. We had a defense buildup underway. We had a dollar that some deemed significantly overvalued. And yet Ronald Reagan, through tax cuts, through regulatory reductions, through the right monetary policy between Paul Volcker and Alan Greenspan, saw the economy grow and grow dramatically. And I think America is poised to grow dramatically. Look at GDP since the summer of the pandemic. It was about $21 trillion. Today it's $28 trillion. We're the preferred investment location for global investment around the world. And I believe that that uncertainty will drop over the coming weeks as we have clarity on taxes, clarity on regulatory policy, and we drop the steep slope of incredible amounts of federal spending coming out of the Biden administration.
Congressman, just away from the events in Washington, D.C. this morning, we'd love a comment from you on the news of this morning elsewhere, particularly in the Middle East. The president posting on social media just moments ago on a truce between Iran and Israel, a very frustrated post from the president. Do not drop those bombs, addressing Israel. If you do, it's a major violation. Bring your pilots home and do it now. And the tone, as we understand, of the president leaving, making his way to the NATO summit in Europe, was a very frustrated president of the United States with Israel, with Iran, and hopeful that maybe we can establish a long-lasting truce in the Middle East. Do you think we can establish peace through strength in the Middle East? And how much of a change is that with this administration relative to the Biden administration over the last few years?
Well, I do think peace comes through strength, and that's been demonstrated by President Trump, both in the Middle East with his Abraham Accords in his first term and with his efforts to end Iran's dismissal of the West. All during the Obama administration and Biden administration, we had appeasement from the Democrats in the White House. They funded Iran's missile operation. They relieved sanctions. They let them sell all their oil on the open markets. They facilitated that money going then to the Houthis, Hezbollah, Hamas, and we've seen the damaging position on that. And so Trump is returning to his pressure on Iran through ending the nuclear program, not delaying it. And I think it's going to change the balance of power in the Middle East for the better. And I think it demonstrates peace through strength. And also, I think the president going to the NATO meeting will demonstrate that again, as European countries now commit to spending 5% of their gross domestic product on defense, standing up a stronger, more robust industrial base and defense posture for Europe. I think that's good for the Atlantic Charter, for NATO, and I think it's good for future peace in the Middle East.
Congressman, we appreciate your time, sir. Busy morning ahead for you. Best
Thanks,
of luck with the
Jonathan.
hearing. Thank you, sir. Congressman French Hill there, down on Capitol Hill. Up next on the programme, we'll catch up with Barbara Doran of BDA Capital Partners, Henrietta Treyz of Veda Partners, Jeff Sherman of DoubleLine, and retired Lieutenant General David Deptula. Live from New York City this morning, good morning to you all. The second hour of Bloomberg Surveillance is just around the corner.
Till geopolitical risk just smacks you in the face, investors just don't want to price it in.
Base case remains that we don't see significant disruptions, neither of oil or natural gas in the Middle East.
Iran is not being reasonable, and it has no allies.
We have more degree of comfort that Iran has limited capacity.
We need to plan for the worst and hope for the best.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Snapping a three-day slide on the S&P 500 in yesterday's session and adding to the gains this morning. Live from New York City, good morning. The second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Equity futures on the S&P up by 0.8%, a 1% move on the Nasdaq 100. Crude, what a move. From the 80s to the 60s in just a couple of sessions, not even. Again this morning, lower by 3%. Brent, 69.43. WTI, 66.54. A fragile truce in the Middle East between Iran and Israel. And the president this morning on his way to a NATO summit in Europe, piling on the pressure, not just on Iran, but Israel too.
Yeah, this is diplomacy via Truth Social. President Trump coming out and saying, Israel, do not drop those bombs. If you do it as a major violation, bring your pilots home now. Donald J. Trump, President of the United States, after saying that he is not happy with Iran, he is not happy with Israel. This ceasefire needs to stick.
Retaliation yesterday from Iran was targeted, orchestrated, well telegraphed, and this market likes that. Market might also like the fact the president's putting the pressure on Israel now to pull back as well. This US, under this president, is not interested in an ongoing war in the Middle East.
They don't want to really get into the question of nation building, which this president ran against, or potentially getting into a protracted type of conflict where any kind of troops go on the ground in the Middle East. We have done that before. It is not popular. Even the strikes the U.S. did execute were not necessarily that popular more widely among the U.S. population. The question now is, how contained is this, and what does that look like given the years and weeks to come when you do have enriched uranium out there, when you still do have some steep animosity between Israel and Iran?
This market's moving on. It's already moved on yesterday. It's moving on and maybe focusing on what happens a little bit later this morning, 10 a.m. Eastern Time. The chairman of the Federal Reserve, day one of two-day testimony on Capitol Hill, and the pressure also rising on him as well, not just from the president. Arguably, it's coming from within the Fed now. Two governors, Waller, Bowman, calling for interest rate cuts potentially as soon as July.
Chris Waller is actually more consistent and has been more consistent about saying that any kind of tariff-related inflation would be short-lived if you want to use the Fed pronunciation of the expression, and has been willing to look through it. Michelle Bowman is more interesting because last year she opposed the rate cuts and has been a more hawkish member. So for her to come out and say if she sees consistent deceleration in inflation, she would support a rate cut as soon as next month, that is catching a lot of people's attention as maybe a second audition for the next Fed chair position.
We'll get into the economics and the politics of that a little bit later this morning. Equity futures so far positive by 0.8%. Coming up this hour, we'll catch up with Barbara Doran of BDA Capital Partners as markets fade geopolitical risk. Jeff Sherman of DoubleLine on a potential reckoning for U.S. Treasuries, and retired Lieutenant General David Deptula on a fragile truce. We begin this hour with our top story. Markets fading geopolitical risk as the Middle East avoids the worst-case scenario. Our team coverage starts right now with Annmarie joining us from the NATO summit alongside Jemana out of Dubai. AMH, first of all to you, a frustrated president making his way over to Europe.
Absolutely. He's frustrated given the fact that he worked hard in his mind with his team to try to make sure that this conflict was not protracted and it was quick. And at the same time, he seems very annoyed what we're seeing in terms of the missiles continuing from both Iran and Israel. He's saying they both need to stop. The president calling on also Israel specifically after he spoke to reporters at the White House. As he's boarding Air Force One, he's heading to The Hague. He then put out a Truth Social post saying, do not drop those bombs. If you do, it's a major violation. Bring your pilots home now. So he seems to be both frustrated with Israel and Iran, saying that they violated the ceasefire. We should note he does go on to say he does think it will last. What we have seen in the past with ceasefires in the region is that the first 24, 48 hours can be fragile. It can be testy. Both sides can be testing the waters. But the president wants to make sure that this is the start of the end of this mini conflict that we've seen play out in the region.
Jemana, that's a change. Not just putting the pressure on Iran, but this morning the president putting the pressure on Israel.
Yeah, and to Anne-Marie's point, I think there was a lot of ambiguity about exactly what time the ceasefire was supposedly implemented. Because when we came in the morning, we saw that Truth Social post that President Trump had put up overnight, but it wasn't until about 8-9 hours later that we got an official response from Israel, the Israeli PM's office putting out a statement saying that they have agreed to that bilateral ceasefire because Israel have, quote, achieve their war objectives. So we're looking to get more commentary from the Israeli Prime Minister later today. And then it wasn't until about an hour or 2 hours after that that we then got an official response from Iran with the National Security Council putting out a statement. So in all of those hours, there was still uncertainty about whether the ceasefire had gone into effect. Both sides exchanging missiles right until the very last minute. Some questions still about whether Iran violated the terms of the ceasefire by launching one last salvo late in the morning. These are some of the delicate questions that we were answering this morning. But I think the bigger picture is there is a truce and an off-ramp has been provided in the last 24 hours. The region is breathing a sigh of relief because we have stepped back from the brink. We have avoided the worst case situation, the worst case scenario of having broader Gulf countries involved in this conflict, broader military intervention from the US's part. And as of now, things are looking a lot calmer. Whether the truce or the ceasefire holds is up for debate at this point, but certainly the president, i.e. the man who was the architect behind this deal, wants to see it last. And you are getting a lot of supportive comments from these Gulf countries this morning, the likes of Qatar, of course, key participants, given everything that's gone down in the 24 hours, saying that they are supportive of the ceasefire that was put in place by President Trump, by the U.S. They help mediate on that front. And the whole region would like to see the tone de-escalate from here onwards. And then the next question is, does this actually bring Iran back to the negotiating table? And if so, under what terms? Now that they are weakened, will they agree to some of the harsher or more stringent concessions that the U.S. administration may be asking for? That's a question for the future. But as for now, the truce appears to be in place.
And the market speaks to that. The market moved. Brent crude, WTI down by close to 3%. Jemana, Annmarie, thank you. Brent and WTI lower, equities higher. This market's doing OK. Here's the view on Wall Street this morning. Barbara Doran of BDA Capital Partners writing, the Israel-Iran conflict will likely continue to be viewed as a regional conflict and not impact the stock market beyond short-term volatility. Barbara joins us now for more. Good morning, Barbara.
Hey, good morning.
That short-term volatility, incredibly short-term over the last couple of days. This market looks bulletproof. That seems to be the assessment of a lot of people. Does that make you comfortable? Does that make you uncomfortable?
It makes me comfortable. I think, we're at the top end of a trading range. The market has had a big V-shaped rebound after the V-shaped, collapse in earlier this year. But I think at 22.5 times earnings, you do have a cap on there. However, what I think is happening now, because you've also had some bullish, as you mentioned earlier, 2 Fed governors, come out to say, hey, I think we should cut in July. And the odds have gone up, since Friday from, I think, 15% to 23%. I don't think it happens in July. But when the Fed did meet, and Chairman Powell's comments last week, he talked about 2 more cuts possible this year based on current economic data. They're not cutting now, as we know, because of tariff uncertainty, what that's going to do. But I think what we're going to see in the short run is the market can move higher, but I think you're going to see a lot of laggards catch up. Small cap is catching a bid, and the entire market should move higher. It's a de-risking. As you mentioned, you've seen oil at 2-week lows. And with the prospect of interest rates coming at some point, interest rate cuts, I think the market is primed to move higher.
Is there a contradiction between the idea of resilience of U.S. markets and economy at the same time that we're talking about rate cuts?
A little bit. I think there always is, because we don't know the timing of the rate cuts. But as we know, the market is a discounting mechanism, so they're looking through that. But again, the big uncertainty is how much is, well, the tariffs, when they flow through, we've had a lot of pull forward. That will be worked off soon. How much will it impact inflation? And will it be one time? And how much will it cut GDP growth?
That's been the question all year. A lot of people thought we didn't have enough data to really show that because there was lagging effects that really wouldn't show up in the data until probably September would be the earliest. Now you have 2 Fed members who are talking about how they might get enough information to cut by July, by next month, at the same time that we're expecting core PCE on Friday. How does that make you understand kind of what's actionable, what's enough data to really make a bet on?
Well, it's feeling like we have enough data because I think the market's impatient. We're waiting to see and we're waiting and every number comes in, it's okay. We're seeing a little bit of a slowdown in the margin, whether it's retail sales, et cetera. And we're going to have an important read later today at 10 o'clock, the consumer, the Conference Board Consumer Confidence. And of course, Friday is the final read on the University of Michigan. And that's been a concern of the Fed. Will inflation expectations come down? Will they get embedded? So we've got more data to come, but it's looking pretty bullish right right now. But again, I think you still have to be careful. We don't have enough data yet, and it should start to show up in the next month or two.
Some data appears to be more relevant than others. How relevant are consumer surveys at the moment to this market?
Well, I think, when you saw them at their worst, it really is an emotional reaction. It was headline after headline on the tariffs. And so I think that they are relevant, but not, because they aren't necessarily good predictors, but they do give you a feel for the consumer, and you've got to watch it. So I think the numbers, I expect them to be better, at 10 o'clock.
Do you think that Friday's core PCE data is going to be all the more important because of what Michelle Bowman, the Fed governor, said yesterday, where she said if this trend continues, she sees there being potentially enough confidence in her, at least, to move next month?
Well, I think it is important. I think it could move the consensus. It seems like with Michelle saying that, you're seeing more of a consensus building within the Fed governors. But I think it's going to be one more data point. It will reinforce inflation looks good, and it's a good starting point, for any inflationary impact. So I think that it may not mean a July cut, but it could move it up to September. And I think it does increase the probabilities, and that does help the market. They'll be more bullish.
If they dissent, it's why they dissent that I think is important. If they dissent because they think inflation's come in and it gives them the space to cut, that's one thing. If they dissent because they point to weakness in the economy, that's quite another. And that's a difficult news conference for the chairman of the Federal Reserve.
And it doesn't speak to the bullish narrative that we're hearing in terms of this supporting equity valuations. And if you have to imagine, if we don't see the inflation show up in PCE or some of the CPI reports, then costs are going up for some companies. Are they just absorbing those? Does that lead to margin compression in a way that might not speak so optimistically, so auspiciously for earnings coming out in just a couple of weeks?
They're not convinced either way, which is why they seem to keep saying, I'll see you in September. Other people on the FOMC have other ideas. Barbara, it's good to see you, as always. Thanks for dropping by. Thank you. Barbara Doran there of BDA Capital Partners. If you are just joining us, welcome to the programme. The rally continues, up another 0.7% on the S&P 500, with an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. President Trump spoke before leaving for the NATO summit. When asked about the ceasefire between Israel and Iran, Trump said, quote, I think both sides violated it. Then, moments later on social media, Trump called on Israel to stop dropping bombs on Iran. Trump announced the supposed end to the 12-day war overnight, writing, the ceasefire is now in effect. Please do not violate it. But within hours, Israel accused Tehran of breaching it. Meanwhile, federal law enforcement officials are on high alert for domestic retaliation in response to the U.S. strike on Iran on Saturday. The Wall Street Journal reporting FBI officials were told to shift resources toward Iran and domestic threats after manpower in recent months had been focused on immigration enforcement. And Fed Chair Jay Powell headed for 2 days of testimony on Capitol Hill. He's expected to discuss the economy, the impact of the Middle East conflict on inflation, and the Fed's independence amid ongoing criticism from President Trump. Ahead of the testimony, Trump posted on Truth Social that U.S. interest rates should be at least 2 or 3 points lower. That's your Bloomberg Brief. John?
Yahara, thank you. Lisa said it earlier, the man never sleeps.
I don't understand this. I mean, he's almost 80, and he is up at 1:32, and then he's up again at 6 a.m. I mean, is this human?
He's got some serious energy. Let's put it that way. Up next on the programme, counting down to July 4th.
Leader Thune has made very clear he wants to stick with July 4th. I am one that would rather focus on good policy rather than trying to meet an arbitrary timeline.
How flexible is that self-imposed timeline? We'll have that conversation with Henrietta Treyz of Veda Partners. She joins us next, live from New York City this morning. Good morning. We're adding some more weight to this rally. Equity futures up again this morning. On the S&P 500, positive by 0.7%. On the Nasdaq 100, up by 0.9%. Led by a de-escalation in the Middle East and this move in crude from the 80s to the 60s. The turnaround in crude is just stunning over the past few days. We're down another 3%. 69.25 on Brent. WTI 66.37 as the attention comes back to the domestic issues. Under surveillance this morning, counting down to July 4th.
Leader Thune has made very clear he wants to stick with July 4th. I am one that would rather focus on good policy rather than trying to meet an arbitrary timeline. And so if we've got to go past the 4th of July to get a bill that is good for not just Republicans, but for Americans, let's try to get it right.
Here's the latest this morning. The fate of President Donald Trump's tax and policy bill remaining uncertain as Senate Republicans plan to begin voting this week. Joining us now is Bloomberg's Tyler Kendall. Good morning, Tyler. It's July 4th and that deadline set to slide.
Yeah, hey, John, good morning. Well, the White House doesn't want it to slide, but they're going to have to do some last-minute wrangling if they're going to meet it, because at the moment, the bill doesn't have enough support to pass the Senate as it stands, and it needs to get through that chamber by at least this weekend in order to tee up a vote on the House floor and onto President Trump's desk by next Friday. And the thing is, a lot of the remaining issues are the ones that we've been discussing at this point for months, including that there's this group of Republicans billing themselves as fiscal hawks that want to see some deeper spending cuts amid concerns from other Republicans about the changes to Medicaid. And Medicaid at the moment really is the most politically fraught issue in this bill for Republicans, considering that the Senate version actually goes further than what the House did in terms of tightening those work requirements and also lowering the Medicaid provider tax. We're going to hear a lot about this because that essentially means that there could be less federal matching funds for the program. Another big sticking point here, of course, is that we've yet to see a compromise emerge when it comes to lifting the SALT cap. Our reporting does indicate there could be a proposal on the table that would keep that $40,000 cap in place, but with a lower income threshold. At this point, though, we haven't really seen any in the so-called SALT caucus get on board with that plan. We should expect changes, though, because amid all of these negotiations going on in the backdrop here is something known as the bird bath, which essentially means that these provisions are being checked by the Senate parliamentarian to make sure that they pass the reconciliation rules. And John, we're already seeing some of the provisions stripped out, including those that had been billed as cost-saving measures. That included one that would have hollowed out funding for the CFPB and another that would have shifted some of the cost sharing onto states when it comes to the Supplemental Nutrition Assistance Program.
An important couple of weeks coming up. Tyler Kendall with the latest down in Washington. Tyler, thank you. To extend the conversation, Henrietta Treyz of Veda Partners joins us now for more. Henrietta, good morning.
Great to be here.
We've talked a lot about this calendar already this morning. July 4th, then July 9th for trade. Let's start with taxes and July 4th. Do you think that slides?
I've got 40% odds that they can meet the July 4th deadline. That's up from 20% where I was last week. Frankly, when there's unrest, whether it's, deploying the National Guard to California or going to war in Iran, that can move things along. There is Senate magic that absolutely does work. But they have about $1 trillion that they can throw at the various problems. As Tyler was mentioning, the Medicaid provisions are atrocious. I think something like 35% of Alaska loses their Medicaid coverage. 600,000 people in North Carolina. So members are very concerned about that. We got to deal with the SALT caucus. They do have $1 trillion to throw money at. But as you mentioned with the bird bath, there are $200 billion worth of savings that various committees have identified that are now gone. They're ineligible. So there's a lot that they need to work through.
There's a lot to unpack there. Right. You said something in there before we get into just how much this does expand the deficit or what to be looking at as it goes through the bird bath, which I love, by the way. You said that when there are wars or deployments of National Guard or Marines, that does its magic in Senate. Do you think that actually has expedited some of the discussions for the one big beautiful bill in Washington, D.C., not necessarily caused fissures among Republican members who have already been really in disagreement?
It creates a sense of urgency. And so specifically to those two pieces, they really match up because there's $175 billion for additional immigration aid. There's $175 billion for additional military preparedness. So focus on those pieces. Don't waste a crisis, as Lindsey Graham always likes to say. Use it, deploy it, get it out there, push this bill through. Because the tax provisions are extremely unpopular for the most part. 60% of Americans know that this bill disproportionately impacts the wealthy. And to the extent that they know anything about this bill, that's their view. So if you can focus on the immigration spend and the military spend, which is popular, that can help grease the wheels.
If you do get some sort of bill that's been stripped down by the bird bath in terms of how much cost saving actually happens, how stimulative could this bill potentially be?
It depends on what income bracket you're in. So the latest analysis that I saw from JCT on their distribution tables, the average low-income family loses $1,200 a year. The average wealthy family will receive $16,000, something preposterous in terms of disproportionate benefits. And that's because you have these preferences like salt, which are extraordinarily expensive. And then you are taking away a lot of the federal subsidies on SNAP, on Medicaid, and those components. So there's a huge wealth variance in terms of who benefits from this bill.
Forgive me for thinking about 2026, but can we touch on the midterms?
Sure.
How do you think this bill will influence the midterms?
Well, you have to think about who's up. So I mentioned Alaska. Dan Sullivan is up in Alaska. That is an at-risk seat if you're going to cut off much of that state from Medicaid. The same is true for Tom Tillis in North Carolina, facing the most expensive race in the nation. And the most expensive race in state history is the expectation. So there's a reason he's going to the mat for the 600,000 folks that will lose Medicaid in North Carolina. It's all eyes on the midterms. I'm more concerned for the Republicans in the House than in the Senate. But this is definitely a conversation for them.
Well, it raises the question, just to build on what John is asking about, this idea, does it make them more inclined or less inclined to vote for the bill? Does it make it more inclined or less inclined to restrict spending versus preserve some of the benefits that people really have come to rely on?
The interesting thing is right now, we're not in the midterm like a general, the way we think about it, where it's D versus R. Right now, we're in the primary season. So now, are you supporting President Trump's agenda or are you not? And that is the main topic of conversation and will be until like January. And then we'll get into the general. We have to pass this bill by December 31st, otherwise tax rates rise for everybody. So it's the problem of the sequencing. We're in primary season right now, which means Republicans have to vote for this bill or they will be the anti-Trump candidate and they'll lose their primary.
Democrats, to some extent, face the same issue, particularly in this city. What do they want to be?
Right.
Who do they want to be seen as going into next year? Socialist or something more in the middle?
I wish they could figure it out. I mean, they are obviously split and their conference is yelling at them to get their primary in just the same way. We want you to be on the side of the extreme progressives, but the general will not accept that and they won't win in the general elections, just like we've seen.
I'm glad you brought that up. Today is voting day in New York City for the mayoral race. I know you're trying to allude to it gently, but there is this big question of how President Trump and his agenda has affected local elections, which have arguably been sometimes more important in terms of setting policy. We've heard some people present themselves as the anti-Trump with ICE policies, and other people say, look, we got to work with him, but at the same time, we're not completely subjugated to them. I mean, it's a really interesting split. How much is that really causing a fissure across the country?
I mean, honestly, I don't think Democrats can keep up with the news flow. When you see, I can't forget that the day that they were sending the National Guard to California, Leader Schumer was holding a press conference on abortion. What are we talking about here? Move it along. We need to get to the right place at the right time, adapt. And I don't think the Democratic Party has done a particularly good job at that.
And they keep picking the wrong side more often than not. Henrietta, it's good to see you, as always. Henrietta Treyz there of Veda Partners. The outcome of this election, I know it's primary season first here in New York City, but the outcome of this could be very interesting for the national stage.
And typically the primary in New York City is the election, because typically it is a Democratic city, and so whoever wins the Democratic election is the one who goes on to become mayor. It raises a question, and it speaks to your point about the Democrats trying to coalesce around a message. What is the identity of the Democratic Party? Is it the Andrew Cuomo, the sort of more backed by mainstream, middle of the road, or is it someone who is presenting himself as a democratic socialist with much more expansionary ideas? And that's something that the city has to deal with.
Presenting himself as one, does that imply he's something else?
Mamdani has come out and he has been endorsed by AOC. There is the more socialist wing of the Democratic Party, the more left wing, and he definitely ascribes to that. He has been gaining. There also is a real test of the ranking system. I could go on and on.
We'd love to hear it.
This has been a completely very, very avid debate at home, but there's this question of ranked voting and whether that actually ends up helping one of the candidates more than doing what it was supposed to do. I don't know. We're going to have to analyze this later.
We'll find some space for it in the next 24 hours. No doubt about it. Up next on the programme, Jeff Sherman of DoubleLine on a potential reckoning for US Treasuries. We'll talk about the bond market and Chairman Powell testimony a little bit later this morning. Live from New York City, you're watching Bloomberg TV. Equity futures on the S&P positive here by 0.8%. A lift to this equity market once again on both the S&P 500 and the Nasdaq, up by 1 full percentage point. In the commodity market, many of you, I know at the moment it's the first thing you check. Once again, we're lower, this time by more than 3%, 69 on Brent. WTI 66. Just think about the last few months or so. At the lows in early May, we dropped to the 50s. Just on Sunday, when this market opened, we pumped through the 80s on Brent, and now we're somewhere in between, 69 69 on Brent, down 3%. 2 hours away from the opening bell, let's get you some single names, some morning movers with Danny Berger. Hey, Danny.
Hey, John, some of these individual stocks also moving on hopes for a ceasefire between Iran and Israel. Some of these defense companies being one of them. RTX down 1.4%, Lockheed Martin down 1.2%. This is a sector that's gained some 6% so far in the month, so a little bit of that reversing if things are indeed calming down. And as you pointed out, oil prices falling, as are energy company stocks. Again, this is another sector, the best performing sector so far this month in June, up 6.5%. Not huge collapses in prices, but notably down regardless. Oxy down about 2%, Exxon down about 1%. Finally, wrapping things up with some individual company news. Uber shares are higher in the pre-market by about 3.33%. Uber launching Waymo on their platform in Austin as of this morning. This is now the second city that you can order a Waymo on your Uber app, the first one being Austin. Uber really hoping to become the platform, trying to convince Wall Street that it is the platform for driverless cars because it already has a lot of customers built in and that name recognition. So getting closer to that. Those shares higher in the pre-market, John.
It's a big race coming together, that's for sure. Danny, thank you. More from Danny in the next hour. On our radar this morning, a fragile truce in the Middle East. The latest from the president posting on social media just moments ago. Israel is not going to attack Iran. All planes will turn around and head home while doing a friendly plane wave to Iran. Nobody will be hurt. The ceasefire is in effect.
And he now signs his Truth Social posts with two different types of sign-outs. One, thank you for attention to this matter, and then Donald J. Trump, President of the United States, when he is very serious at a time when he wants to see the ceasefire remain in effect. This becomes really a key diplomatic point for him ahead of the NATO meetings, which we'll get into in just a second. Whether this has any ramifications for markets, they've already moved on because they don't see the prospect of some sort of disruption in oil supplies, and that seems to be the a sort of very narrow way that the markets are looking at this.
He wants NATO members to spend more, and at home we're about to do the same thing. Senate Republicans are coming around to a $40,000 SALT deduction cap, but want to lower the income threshold. SALT is one of the key hold-ups in passing the big, beautiful bill, and whether we can do it on time, and I stress on time, is a self-imposed on time of July 4th.
Yeah, there has been sort of a no-go kind of provision from the likes of Mike Lawler of New York, who have said it's got to stay $40,000 in terms of the cap on the SALT deduction. If they kind of backdoor this and say people with incomes below a certain point can have that $40,000 cap, other people not so much. Let's see if that flies. People would argue that this really only applies to people who are in some of the higher tax brackets. So there are a lot of questions around this. It does just throw another wrinkle into this very aggressive timeline.
First few weeks of July are going to be very interesting. July 4th, the imposed deadline for the tax bill. July 9th for the trade story. Danny mentioned this story. She touched on it. Regulators looking into safety violations from Tesla's robotaxi launch. Telling us here at Bloomberg, they're aware of videos posted to social media showing the cars entering wrong lanes and crossing double yellow lines.
So this goes to the heart of the question behind the rally that we saw in Tesla initially on the heels of President Trump's election, which was, would this expedite some of the regulatory hurdles for robotaxis to really take off? A lot of people saying this is the future. This really has been the sort of big argument for the bullish bet on Tesla. Does this stymie it? Right now, it seems like not so much because people saw cars going. And I have to say, the feature where the lights flash when the robotaxis pull up to let you know that that's the actual one to get into, I kind of think that's cool. I always kind of struggle when you get an Uber or something and you're not sure whose car it is, if they flashed.
Oh, that would help.
That would help.
Do you not use the PIN code for when you get in?
Well, some of them use PIN codes, some of them don't use PIN codes.
Check the license plate.
You have to check the license plate, but it would be really nice if, especially in an airport. I need to get off my soapbox this morning.
No, I do the same thing. I'm on the soapbox with you. Do exactly the same thing. Check the license plate.
Yeah. You check the license plate. You walk in. You say their name. You try to act very
Jonathan,
polite.
I pick you up all the time.
So that
this is the habit I go through.
Why did you give me a 4.3?
Do you do that?
No.
4?
I don't get that.
Do you give people low ratings?
No, I don't do that. I actually don't.
First thing in the morning.
Partly because of it, even though, yes, I know, I wouldn't do that.
What's your rating now?
It's not as good.
All right. We'll do that another time. Let's turn to fiscal policy, a favourite of Lisa. Fiscal risk back in the spotlight for the bond market. Geoff Sherman of DoubleLine saying this: we are neutral on intermediate treasuries. The market is focusing on the fiscal side, which could drive rates higher over the short term, given the one big, beautiful bill. Geoff's here in New York. Geoff, good morning. Good to see you.
Morning.
Lisa and your colleague made the headlines in the last week or so. A reckoning is coming for the US debt market. So just refresh our minds, our memories. What is the stance of you and the team at the moment on the Treasury market?
Well, the Treasury market has a lot of risk in it today, and we're seeing this from all the fiscal uncertainties that we see out there. We're debating whether the policies will indeed be stimulative, but at the end of the day, we all know that it's really bad for the deficit. And no matter how one looks at it, slapping on an additional $2 trillion over, what is the time frame? Is it over a couple of years? Is it a decade? We all have to argue what the benefits are as well. So what you've seen, even like when I look at when the markets opened, with all the conflict we had over the weekend, actually treasuries were off once again, right? The yields were up. They were selling in treasuries to begin kind of that trading session, even though oil was spiking at that time. And so is it the inflationary impulse, or is it the lack of flight to quality once again? And so this has been on investors' minds really for the last couple of years, is that, there is a day of reckoning one day when it comes to the treasury market. Is it June of 2025? It's not likely. Luckily, we only got one more week left, right? It's probably not July either, but this is just not tenable over the long run. And so the challenge is you have, the president, with Jay Powell's testimony today saying Jay needs to lower 2 or 3 points on rates practically overnight to really help them continue to spend. But maybe the answer really is, and this is where we shake on it, maybe they don't need to spend. Right? Maybe they need some pain from the bond market to say it will be punitive that if we continue to follow these policies. So tax cuts sound great, SALT sounds great, all these things sound great to wealthy investors. But at the end of the day, we are mortgaging the future.
Just to build on that point of what Jerome Powell is going to be facing off with in Congress, President Trump has gone after him again and again, talking about lowering interest rates to make U.S.'s borrowing costs go down. How much does that affect your calculus as well, especially as you have 2 Fed governors saying, yeah, as soon as July, we could see rate cuts?
Yeah, we saw Bowman come out yesterday with those comments as well. But look, it's not this democracy at the Fed. Typically, what you have is the chairpersons in charge trying to coalesce, gather, kind of sentiments. Not like in the UK where there's lots of dissension and you get 5-4 votes. I mean, there tends to be this unanimity across, when the policies come through. And so I'll give Jay kudos that he went from being Bonehead Jay, just too late now is the nickname that he's getting today.
Graduated.
Yeah, I don't know. Too late sounds better than Bonehead, I think. I think Jay Powell's a pretty smart man. But look, at the end of the day, he's told you his positioning. I don't think that changes in front of Congress right now. And the fact that, what was it? I don't even remember the quote this morning that President Trump said, but it was like that they need to, go after and attack Jay Powell. It's not going to change the stance. It's not going to change monetary policy, as they're still worried about the inflationary effects of the tariffs. And so, this multipolarity world we have and all the variables going on, it's just not as simple as lowering rates, because at the end of the day, you lower rates, you condone the behavior of our elected officials, you condone the deficits, and effectively it could lead to an inflationary impulse on the other side.
Yeah, there are these sort of dueling risks. We've been talking about this all morning, inflation versus growth fears. Yep. And if the Fed were to cut rates, that could do some damage to inflation expectations to the upside. This could necessarily prolong, though, also the growth cycle. Given the fact that your colleague Geoffrey came out and said that credit really looks incredibly risky in terms of the valuations and what you're getting compensated for, if the Fed were to ease policy, would that improve the credit outlook, or would it make it more vulnerable?
Well, no, I mean, it would improve it. At the end of the day, what you got to think about is there's twofold. One is, as an investor, we have to think about that incremental yield or the spread we get for taking on the credit risk. That's what he's referring to when he talks about valuation being tight, right? We look at high yield bonds. They're massively below average on their spread. I don't feel like we're in a below average risk world today, right? Which those two things usually coincide. But at the end of it, it's debt service as well. And so this has been the argument for the high yield bond market and the like, is that if rates come down, then essentially refinancing these coupons becomes more accretive and more helpful over time. So once again, you kind of have these dueling things, right? You're not getting compensated meaningfully for taking this incremental risk. But then at the end of the day, when you look at some of these companies, though, they're good quality names, right? And so even they may exist in the high yield bond market.
How much does this really complicate the discussion about U.S. exceptionalism and the loss and sort of the flow of funds elsewhere? I know that DoubleLine has been looking elsewhere, talking about how the U.S. is spending too much, not cutting financing, and also some of the trade policies. But you see also Europe spending. Yeah. And today we see with the NATO meetings this commitment to 5% expenditure of GDP on military. doesn't it sound like the same thing over
but
there?
At least President Sun would say it's about time, right? That instead of us footing all the bills for NATO. Now, again, you're going to get different people on different sides of the aisle on that statement. But at the end of it, what you're talking about is this self-sustaining, is there exceptionalism? And one of the big benefits the U.S. has had over the last decade or so is that we have had the capital flight into our country. You know, people talk about this when you talk about emerging markets. The first thing you talk about is what's the FDI, the foreign direct investment. Well, the U.S. is a massive benefactor from foreign direct investment, right? Our stock market, our bond market, our trading partners, which helps essentially finance our deficits as well. So the big challenge with all of it is that if you're going to disrupt that, and I'll call it the orthodoxy, and that seems to me what Trump is doing, is that you're going to have downstream ramifications. Now, no one knows what it'll look like if investors pull capital. But I was concerned when we first started the tit-for-tat tariff that given the fact that we run such massive trade deficits with certain countries, we couldn't do a tit for tat. There's no way we could up our tariffs enough to really be punitive enough. So one thing that could happen the other way is that they could effectively say, we prohibit investing in the U.S. or incremental dollars should not. And you can see that from, let's say, sovereign wealth funds. You can see that from different governments around the world. So that's not off the table today. And look, we have 2 weeks till the self-imposed deadline on the tariffs, right? That we're going to have I don't know if they're called big, beautiful tariff deals, but we have that for the 2 weeks as a self-imposed deadline there. And thus far, we have one kind of puny, trade deal thus far is with the UK, and not much really occurred there. So baseline tariffs seem to be here to stay. That means costs of things will go up. It's just a question of is how much. Someone has to eat that cost along the supply chain, and effectively that will end up in consumers' hands at some point.
You've touched on some really important forces. I just want to go back to the beginning of those comments. Well, the president's message is to the rest of the world, we don't want your exports, but we want your capital.
Right.
What we've been asking is whether you can have one without the other. Do you think we can?
It's difficult, and that's what I'm saying. It's a disruption to orthodoxy, right? So historically, you haven't, and typically when you think through what happens with the trade deficit, is that well, if you're the exporting country, well, all of a sudden you're generating these dollars. Let's say in the case of for someone like Japan, who's ran a structural deficit for 4 decades, right? Well, they generate dollars. What do they do with those dollars? Well, they recycle them in the treasury market. It brings stability to their currency. It helps them kind of manage the flow of that import-export business. So at the end of it, there is some disruption on the other side. And to me, that's the biggest wild card. But still, we don't know what the end game is on tariffs. We don't know what it ultimately looks like. They keep lauding the art of the deal, and this is all about negotiation. But what's the end game? And I think that's the thing that people have trouble seeing today. So it brings me back to what do? You don't trade it. You don't trade it. You don't try to get caught up in it. You know that there's more tariffs coming. The thing we're still concerned about is more sectoral tariffs, right? We've seen this with the steel and the aluminum. They're going to go after the pharmaceutical industry. They've been very vocal about that. So there's things that you can kind of try to avoid going forward. But at the end of it, centered at trade is our economy, right? And so at the end of it, it depends on what we look like in growth. And the growth variables are very noisy right now, right? Because of the front loading of all the import data in the first quarter, we gave it back in the second quarter. That's why you see this big jump in estimates for second quarter GDP. But is it really growth? It's really just the import-export mechanism. But thus far, and this comes back to your comments about Jay Powell, is that he's focused on the labor market right now, because right now he sees that the tariffs are going to have uncertainty. It's going to take 6 to 9 months to know what that looks like. So right now he continues to focus on the labor market, which has been surprisingly strong throughout this whole cycle. Thus, that puts the Fed on hold. And, I think that his baseline is no cuts this year, no matter what the rhetoric comes out of Waller or Bowman this week. And remember, we're going to get a new Fed chairperson next year. That's the big wild card. It's not what happens in this next 9 months. Yep. It's effectively who that person is, how much control the president has over that person's say-so. And that, to me, is the biggest wild card for the bond market.
Hey, Jeff, it's good to catch up. Appreciate it. Could talk to you all morning. Jeff Sherman there of DoubleLine.
Thank you.
In the equity market at the moment, we're still doing nicely, up by 0.5 to 0.7% on the S&P through much of this morning. With an update on stories elsewhere this morning, with your Bloomberg brief, let's cross over to Yahara Anand. Hey, Yahara.
Hi, John. In a win for the Trump administration, the Supreme Court lifted a judge's order that required the government to give people 10 days notice before they are deported to a third country. The case stems from a lawsuit back in March by immigrants who feared being removed to countries that are not their own. Meanwhile, 170 million Americans are facing a heat wave this week. From the plains to the East Coast, temperatures will be between 90 to even above 100 degrees. The blistering heat took a toll on power grids in New Jersey and in New York, with thousands stuck without power. And Game 7 of the NBA Finals was a ratings success, drawing the largest single-game audience in 6 years. The winner-take-all game saw an average of 16.4 million viewers across streaming and cable platforms, according to Disney. But despite the big numbers for Game 7, the rest of the series averaged the least amount of viewers since 2021. That's your Bloomberg Brief. John?
Yara, thank you. It's just not a great product, is it? You knew that was coming.
Oh, my God. That was basically a
product.
softball. Like, John, what do you think of this product?
Just not a great
basketball
product at all. All right. Up next, the president's patience wearing thin.
These guys got to calm down. It's ridiculous. I'm not happy with them. I'm not happy with Iran either. We basically have two countries that have been fighting so long and so hard that they don't know what they're doing.
The president dropping a different kind of bomb this morning. Up next on the program, the retired Lieutenant General David Deptula joins us next, live from New York City. Good morning. The news flow just incredible, non-stop over the past few weeks. It continues. Equity futures this morning still positive in the face of it, up by 0.8% on the S&P, on the Nasdaq, up by 1 full percentage point. Under surveillance this morning, the president's patience wearing thin.
I'm not happy that Israel's going out now. These guys got to calm down. It's ridiculous. I'm not happy with them. I'm not happy with Iran either. But I'm really unhappy if Israel's going out this morning. We basically have two countries that have been fighting so long and so hard that they don't know what they're doing.
Here's the latest this morning. President Donald Trump lashing out at Israel and Iran. The president accusing both sides of violating a ceasefire agreement to end nearly 2 weeks of fighting between the two nations. Joining us now is the retired Lieutenant General David Deptula. Retired Lieutenant General David Deptula joins us right now. Lieutenant General, can I just ask you this? A lot's happened over the last few days. In your opinion, what's changed?
Well, I think, John, what's changed is the fact that Israel has achieved air superiority, if not air supremacy, over Iran. And now Iran is understanding that it is subject to Israeli lethal effects whenever and wherever they want to. So that is what has led Iran to initially agree to consider negotiations. But as you saw in the violations of the initial elements of the ceasefire, Iran continued to fire ballistic missiles against Israel, resulting in death. So it's probably going to take a bit more application of force on the part of Israel, and quite frankly, the continued application of force until Iran finally gets the message that if they don't come to the negotiating table, they're going to continue to see their regime and their capabilities weakened and ultimately destroyed.
There are two different questions here. There are a lot of different questions. One is the market-related question, which is, will oil supplies be disrupted? That seems to be not so much, and that's what we're seeing priced into the markets. There's a larger question of, will Iran's ambitions to be a nuclear state really be hampered for a longer-term kind of time frame? What's your take on that, given the 400 kilograms of enriched uranium that currently is missing in action?
Yeah, Lisa, actually, that's a great question. At a fundamental level, nuclear capability consists of three essential components. And Israel and the United States has targeted each of them. The first one's human expertise, and that's the knowledge required to design and construct nuclear weapons resides in a small cadre of specialized scientists and engineers, and Israel's made a concerted effort to neutralize that capability. Then, as you mentioned, there's the fissile material. Most importantly, uranium enriched to weapons grade levels. Right now, there are 400 to 500 kilograms of enriched uranium that still exists in Iran. But strikes on the enrichment sites at Ferro and Natanz have severely disrupted the ability to process it further. And then number three, there's the weaponization and assembly infrastructure. So even with the knowledge and material, Iran needs the facilities to assemble a functioning nuclear weapon. So 2 out of these 3 elements have been severely impacted. So what remains is a fragmented element, if you will, but it's hardly the foundation for a viable nuclear weapons program. So I think you've seen Israel and the United States cripple Iran's operational nuclear capability, but obviously there's the potential to reconstitute.
There's a question about deterrence when it comes to Iranian nuclear ambition. It's also deterrence on a global scale heading into NATO. What's your sense of whether this action by the United States acts as a deterrent or not to other states that might be contemplating nuclear status or incursions into other areas around the world?
Well, I think it's an excellent point, and I think part of the benefit of what President Trump did is not only, and what I'm talking about is with going forward with the B-2 attacks against these processing facilities. First, while that set back Iran's potential to develop a nuclear weapon, it was fundamental to restoring U.S. credibility on the world stage. We've seen, and we spent a lot of time talking about this, but the disastrous withdrawal from Afghanistan and then seeing the U.S. being deterred by Putin, what this action did was, hey, look, the United States now acts behind its words. It just doesn't talk and take no action. So I think that will have an impact with respect to not just our potential adversaries, but our allies alike.
Lieutenant General, always appreciate your time, sir. Thank you for making a few minutes for us this morning. Thank you. The retired Lieutenant General there, David Deptula. The consequences extend beyond the battlefield in Iran, extend to potential and actual battlefields right now and maybe in the future.
It goes to the question of what the U.S. does with respect to Russia, Ukraine, if anything, and heightens that conflict during the NATO meetings. And then there's a question of China and Taiwan. And people have been wondering if this is a warning message or if this is a sense that maybe the U.S. is distracted. You can make arguments on whatever side you want. And that's one thing that I've noticed from different experts who've come on, how far you have to go and what exactly this does in terms of a deterrent.
This market's moved on, reinforced by the events of the last couple of days, moved on. Equities are higher yesterday and again this morning. In the commodity market, crude pumped for a little bit like 2 hours or something like that and faded aggressively through the 80s and Brent and then back down into the 60s. And we move on as well. In the next hour, we need to be talking about the Fed Chair, Jay Powell. Jay Powell on Capitol Hill, 2 days of testimony. He's going to face a real grilling a little bit later. How often do we say that? But this time he might actually. Coming up next, we'll catch up with Emily Roland of John Hancock, Stephen Schork of the Schork Group, Torsten Slok of Apollo, and Troy Gayeski of FS Investments. Live from New York, the third hour of Bloomberg Surveillance is up next.
Just because the market is being resilient doesn't mean that the risk isn't going to come back and bite it later.
Market and energy traders are still trying to understand what is the calculus here.
It would take some time for markets to get more confidence in the base case outlook for disruption.
There's a lot of uncertainty, but there's absolutely no volatility.
The market will respond when the circumstances change, either for the better or for the worse.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now, and your scores look the same as they did yesterday. We had some weight to the rally. Once again, equity futures on the S&P up by 0.8%. On the Nasdaq 100 up by 1 percentage point. The changes, though, we've seen in the commodity market, unreal. Look at Brent crude this morning. Right now, 68.97. The high of the week. The week's only 2 days old, by the way. The high of the week, 81.40. The low of the week, 67.50. the range on Brent crude in just the past few days.
This is the type of volatility that we saw at the peak of some of the pandemic-related uncertainty during the closures and then the reopening at a time when people couldn't really understand exactly what the backdrop was going to be. It shows just how volatile this is. This shows also why people have become benumbed. If you were benumbed, you did well. If you tried to buy and sell, well, good luck to you. And that's the reason why people don't necessarily respond aggressively to some of these geopolitical risks.
Conditioned by the moves of the past few days once again, and maybe even more desensitized over the past couple of weeks off the back of some of this. Later on this morning, another event on the calendar for you. Chairman Powell, 2 days of testimony on Capitol Hill. It's day one today in front of the House Financial Services Committee, and coming into it, the Federal Reserve is under pressure, and the president is turning up the heat.
At 1:32 a.m. in a Truth Social post where he said, too late, Jay Powell does it again. He also said, I hope Congress really works this very dumb, hard-headed person over. Jeff Sherman of DoubleLine saying that that's an upgrade from some of the previous monikers that he got from President Trump. We will be paying for his incompetence for many years to come. This complicates a very real economic debate that is happening right now across Wall Street, which is, what is the bigger risk to the U.S. economy? Is it potentially weaker growth, or is it inflation? This dual risk that we are seeing sort of come to the fore in terms of the debate, where you have Bowman and Waller on one side, and you've got the Fed chair very much on the other.
The front end of the curve has just been anchored around this do-nothing posture over at the Federal Reserve. Just introduced some risk around that, I think, over the past couple of days, and maybe introducing the belief, for some people at least, that perhaps some of these meetings this summer might actually be live. And we might not just have to take the summer off.
So to put some numbers around that, right after last Wednesday's Fed meeting, there was about a 10% chance of a July Fed cut priced into Fed funds futures. Today, it's something like 23%. And this is after what we heard from Michelle Bowman as well as Chris Waller. So introducing the sense that even if we don't get a rate cut in July, we might get dissents for the first time in a long time.
Bond yields down by 2 basis points at the front end on a 2-year this morning, 3.84. Coming up this hour, we'll catch up with Emily Roland of John Hancock as markets digest the fragile truce in the Middle East, Stephen Schork of the Schork Report as oil markets roll over, and Torsten Slok of Apollo as Fed Chair Jay Powell heads to Capitol Hill. We begin this hour with our top story. President Donald Trump lashing out.
I'm not happy that Israel's going out now. These guys got to calm down. It's ridiculous. I'm not happy with them. I'm not happy with Iran either. But I'm really unhappy if Israel's going out this morning. We basically have two countries that have been fighting so long and so hard that they don't know what they're doing.
His next stop, a NATO summit in Europe. There right now is Annmarie. Annmarie, a change from the president. Harsh words not just for Iran, but Israel too.
He's clearly lashing out and blowing off some steam this morning before he made his way onto Air Force One to come to The Hague to the NATO summit. He's saying that both Iran and Israel, he believes, were in violation of this ceasefire, and putting a lot more pressure on Israel. He then took to truth and said that Israel will not attack Iran. Potentially, he was responding to what we heard from the Israeli Defense Minister, Israel Katz, talking about the fact that they told the IDF to respond to Iran. This would have been after the ceasefire that the president said came into effect. So he's clearly very frustrated with the fact that this is a fragile ceasefire. And even though potentially is the start to the end of this 12-day or so conflict, and right now we do not have a protracted regional war, the fact of the matter is this is very tense and fragile. I was speaking to one senior observer of this region for years who was saying that the way they view it is that Israel now views Iran the way they view and have viewed in the past, say, Lebanon and Lebanese Hezbollah or Gaza and Hamas. If they see intelligence that could potentially be a threat, they will go out and neutralize it ahead of time. That means that we are going to be living in a very different, fragile region when it comes to the Middle East.
Looking forward to your coverage over in Europe over the next 24 hours. Annmarie Hordern at the site of the NATO summit, which the President of the United States is heading towards right now. Here's the view on Wall Street this morning. Emily Roland of John Hancock Investment Management writing the following. Elevated geopolitical risks are not showing up in US markets just yet, where the focus is on managing risk in portfolio. Joining us now, I'm pleased to say, Emily Roland. Emily, let's talk about this a little bit more. Here's the question from me. What risks are actually worth managing at the moment? Because for a lot of people, they're being rewarded by just ignoring pretty much everything.
It's amazing, John. It reminds us a bit of the Talking Heads song, Same as It Ever Was. Just looking back a week, you saw the typical geopolitical risk management narrative playing out with the dollar briefly catching a bid. You saw oil prices obviously higher, gold getting a bid, and all of that has quickly reversed. This is one of the biggest head fakes that we've seen for investors in quite some time. And now we're once again spitting distance from new all-time highs, sitting at 21.5 times forward earnings. Investors are chasing the riskiest areas of the market, really embracing a momentum-driven strategy, looking at pockets like unprofitable mid-cap growth stocks, and European equities is really the playbook this year. So really very little risk priced into the markets. High yield bond spreads sub 3%. Markets seem to be calling the all clear here. We think it's more important than ever to consider risk management.
Max Kenner of HSBC asking a question, and I'll quote him directly. We think the biggest risk to our view is that we're not bullish enough. Ali, what are you suggesting people do then? Fade these moves? If so, how? Rotate out of what and into what?
Totally agree. This market is just pushing you into risk, John, and it's been really hard to resist that momentum. This technically driven, sentiment-driven market has been a big challenge. It's not to say we don't have exposure to risk assets. We still love high-quality stocks, ones with great earnings potential, good ROE, lots of cash. We're looking to find quality at a reasonable price. So we're finding it not only on the growth side of U.S. markets, but also in sectors like healthcare and utilities. We've been talking a lot with investors about infrastructure-related assets. So these are the things that people need versus the things that they want. Look, the economic growth trajectory in the U.S. isn't great. It's not terrible, but the data have disappointed. We're starting to see cracks in the labor market. The consumer's coming under pressure with retail sales disappointing. So we want to be positioned for that environment, but markets are almost completely ignoring it and trading on a different planet. We think there's opportunities to trim risk here. We still think that the elevated yield available in bonds is very attractive here. Stocks are priced for perfection, and bonds to us are still mispriced for this disinflationary, slower growth environment that we see playing out through the back half of the year.
Emily, if this is truly a disinflationary environment, then maybe Michelle Bowman and Chris Waller are onto something, and the Fed should be cutting potentially as soon as next month. Is that inconsistent with the idea of the resilience in U.S. equities, or does it help fuel it?
For now, it helps fuel it. So you remember we talked a long time ago about the pivot party. There's a period where rates are coming down, disinflation's coming down, growth is slowly slowing, where equity markets are going to celebrate that because we know that stocks love a lower cost of capital. But then there does become a point where bad news is just bad news as it relates to growth. We think right now we're still sort of in a celebratory environment where disinflation through housing and shelter is playing a really key role. We actually do think that some of the recent Fed speakers, it makes a lot of sense. In fact, the Fed, if they were data dependent, they may be cutting already if it weren't for the specter of tariff-driven inflation. It was amazing to hear Powell last week say that every forecaster he knew suggested that inflation on the good side was going to pick up over the next several months. I don't know, maybe he's not reading the weekly emails that Matt Miskin and I are putting out there, but we've been highlighting the fact that housing and shelter disinflation, which is a much bigger component of overall inflation, is significantly slowing, which we think could actually offset the potential inflationary impacts of tariffs here.
If the Fed doesn't cut for the remainder of this year, do you think that that alone could actually accelerate a downturn in the economy and actually could end up leading to a protracted bout of weakness?
Yeah, I mean, you think about higher rates having this almost self-limiting mechanism where, you look at mortgage rates, picking up around 7%, that housing is completely unaffordable for many Americans right now. You think about credit card debt, auto loans all being elevated. There's a limiting factor that takes place the higher that rates remain that we think actually pushes growth lower. So we think it makes a lot of sense for the Fed to consider cutting here. It's probably, in our view, back end loaded as it was last year. The Fed obviously doesn't want to kowtow to any pressure from the executive branch in Washington. We are watching that really closely. So we think maybe they give us a little bit more color at Jackson Hole in August, probably not doing anything anytime soon, but we see the case for more aggressive cutting than markets expect as we look at the the sort of later stages of the year.
So, Emily, what are the investment ideas you've got around that view? Do you sit at the front end and ride the rally on a 2-year, say, if you expect that deep cutting cycle that's not priced in? Are you moving out of cyclicality in the equity side of the portfolio? What are you suggesting people do?
Yeah, on the fixed income side, we're looking at the intermediate part of the curve, areas like MBS, investment grade corporate bonds, single A, even treasuries. We're looking at a benchmark level of duration, so right around 6 years. We're not going all the way out to the long end of the curve. The challenge, though, is sitting in the short end of the curve, is investors might miss out on the total return potential that is at play here in high quality bonds. The most popular investment within fixed income by far is still money market funds. We're sitting over $7 trillion in cash right now. The advisors that I talk to when I'm traveling say that their clients want to roll over those CDs and continue rolling them over. The challenge there is that investors tend to embrace money market funds all the way until rates are zero, and then they look to bond investments after a great period of performance. So investors tend to miss a lot of that duration benefit. So we're suggesting legging into duration, looking at the intermediate part of the curve, fading the momentum, sentiment-driven rally in areas like growth at any price stocks, European equities, which have been rallying on negative earnings growth, and redeploying that into a mix of high-quality stocks in the United States that are trading at a reasonable price.
Emily, beyond equities, I just want to finish on the bond market. There's an important assumption that we've all got to make a decision on. What happens to the long bond if growth does decelerate, if rates are cut at the front end, which is what the Fed controls, Fed funds? What happens to the bond at the long end?
Yeah, I mean, we think that bond yields fall across the curve here. We've seen this really unusual environment where this bear steepening has played out. That doesn't happen very often. And really, there's an argument out there that politics are driving that. There was a huge question. You guys asked every single person that came on over the last few weeks, are you buying the 30-year Treasury at 5%? We don't think it's the worst idea to own, look at every backup on the 30-year as an opportunity around 5%. There's a lot of volatility there, so you've got to right size it. But we do think ultimately yields across the curve come down here as growth decelerates and disinflation sets in.
I can sell you 490 this morning. Emily, it's good to see you, as always. Thank you. Emily Roland there of John Hancock Investment Management. Bond yield higher this morning by 2 basis points at the long end, but lower at the front end by 2 basis points. And this is the complicating issue for those of you that would like to unlock the housing market and get mortgage rates lower. The last time they cut interest rates, what happened? The long end sold off and yields rose and mortgage rates went up.
And could that happen again, especially if inflation expectations go up? Everyone seems to love the belly of the curve, the 5-year yield. And this is the reason why the yield on 10-year treasuries is now the highest relative to 5-year yields going back to late 2021. It just shows how distorted the market is getting around some of these views.
About a 45 basis point spread as we speak. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. President Donald Trump accused Israel and Iran of violating the ceasefire he announced yesterday. Speaking to the media before he boarded Air Force One to head to the NATO summit, Trump expressed frustration with both countries and told them to calm down. Meanwhile, world leaders are gathering in The Hague for a 2-day NATO summit. As I just mentioned, allies are expected to endorse a goal of spending 5% of their GDP on security. But Spain's prime minister is refusing to agree to spending increases, arguing that 2.1% will be sufficient. Now, NATO Secretary General Mark Rutte needs to keep Spain in line while also preventing others like Slovakia from breaking ranks. And passengers on a Paris-bound Qantas flight spent more than 15 hours in the air, only to end up back where they started. The flight departed from Perth, Australia, making it into Indian airspace before an Iranian missile attack closed airspace in the region, forcing it to turn around. The plane landed safely back in Perth earlier today. That's your Bloomberg Brief. John?
Brutal. 15 hours. Absolutely brutal. Yahara, thank you. More from Yahara later this hour. Up next, the Morning Calls Plus. Stephen Schork of the Schork Group as oil prices roll over and drop back below $70 a barrel. That conversation up next, live from New York City this morning. Good morning. The opening about 1 hour and 12 minutes away. Your scores look like this. Positive by 0.7%, just off session highs, but adding some weight to the rally that started yesterday, snapping a 3-day slide on the S&P 500 in yesterday's session and adding to the move so far this morning. On the Nasdaq 100 up by 0.9%. That's the stock market picture. Here are your morning calls. First up, Goldman downgrading Dollar General to neutral, seeing limited upside due to intense competition. That stock is down by 0.5%. Your second call from TD Cowen, upgrading Lyft to buy, citing growth potential from international expansion. That stock is up by 5.5%. And your third and final call from Citi, raising its price target on Alphabet to 203, pointing to an improving digital advertising market. That stock is up by 1.25%. Let's turn from the morning movers and some of the morning calls to the commodity market. Crude oil dropping as the Middle East avoids the worst-case scenario. Stephen Schork of the Schork Group writing the following. Geopolitical risk is underpriced. The market assumes the ceasefire holds. History says be skeptical. Stephen joins us now for more. Stephen, welcome to the programme, sir. Let's start with that quote, that last line. What about history makes you skeptical?
Yeah, absolutely. We've seen this playbook before, Jonathan. And right now, what the markets have done, what the oil markets have done, they're pricing in a peace treaty. All we have now is a ceasefire. And as we learned this morning, a tenuous ceasefire at that. Yet the market is pricing as if this were January 1991, when Desert Storm commenced and the West overthrew, the West with the help of its Arab allies, overthrew Saddam Hussein. And this is what the market's doing. It seems a bit premature at this point that we only have the ceasefire. It's not a peace treaty. The Tehran has not been overthrown by a pro-Western government, and yet prices have completely, I think, in our modeling, have overpriced this move.
Stephen, some people might say it's even better than the early 90s. In the early 90s in America, we were producing something like 7 million barrels of oil a day, and now we're close to double that. It's a well-supplied market, and we've learned from the Iranians they're not going to do anything about the Strait of Hormuz. Why should I pay attention to this situation? What do you say back to that point?
Well, let's be clear. The Iranians are doing something in the Strait of Hormuz. There's been GPS jamming and spoofing of navigational systems coming out of Tehran. So over the weekend, we had 2 VLCCs, very large crude oil carriers that can carry each 2 million barrels of crude oil, turn around to avoid the strait. So we do have a soft blockade, which will put pressure on crude oil supplies. So therein where it lies. We can only move crude oil prices higher if we see a disruption to the flow of oil, and we are seeing that on global markets. To address the issue about domestic production, yes, the United States is the world's largest producer of crude oil, but we do not produce, let's be clear on this, we do not produce all the crude oil we need. So crude oil comes in very different varieties of viscosity, weight, so forth. Our refineries are geared, the majority of that, to refine a specific type of crude oil, which we don't necessarily produce. So the United States has to sell that crude oil on the global market and buy back the crude oil it actually needs. So yes, while you want to think you can make an argument, and in some ways you are, that we are energy dependent, no, we need foreign crude oil, again, because we don't produce as much as we do, we don't produce as much as we need.
The U.S. may not necessarily be immune to any kind of shipping disruptions, which I think is sort of what your point is underscoring. At the same time, there is more capacity to produce. There are a lot of oil rigs that have been taken offline in the past 6 months. There's been a discussion around $65 a barrel oil, and that's needed to bring some of those oil rigs online. How soon do you see that happening as a potential offset to any kind of supply disruption?
We are, at least, unless we see a sustained rally, that is sustained prices. I do think $65 a barrel is too low, because we've been there pretty much for the majority of this year thus far, and we haven't seen an increase in production. Now, the Dallas Fed put out a survey at the beginning of the year asking oil executives what price do they need to see to excite them to bring more oil to the market. And that range was in between $71 and $75 a barrel. So we did pop over there briefly, but this rapid decline that we've seen, and yesterday we saw one of the largest declines ever in 40 years worth of oil trading. So that is going to scare a lot of executives. It's going to keep them correctly skeptical that this rally has any sort of staying power. So to answer that question, we are, at least I believe, a quarter away before we'll see any sort of price reaction, because the executives have to be sure confident that oil above $70, $75 a barrel is here to stay. This kind of volatility is going to scare off production and is not going to, regardless of the headlines, it's not going to introduce more production from the U.S. into the market.
It's also going to scare off traders that are trying to make a market and try to understand what kind of risk premia to put on the myriad risks that are out there. You say that geopolitical risk is underpriced. What kind of price do you assign it, given the volatility that we've seen in prices over the past couple of months?
Yeah, absolutely. Great question. And look, we've got, as I said, we have 40 years worth of trading. So we have 40 years of Iraq invading Kuwait, Desert Storm, all the stuff that we saw in the early 2000s. So we've seen plenty of spikes, plenty of surges. So we know how to model those potential jumps in the market and address that drift and address that volatility. So it does take a little bit of mathematics, a little bit of probability analysis to assign a potential range. So what we've done for our third quarter pricing that we just issued yesterday is in potential outcomes, our interquartile range, that 50% envelope of where prices could trade, ranges in between $85 a barrel and $63 a barrel. Now, if we have a tail event, we see a further escalation of hostilities, and most importantly, we see a disruption to the flow of crude oil, then we go out to our tail risks. And this is based on kind of the volatility, the jumps, the amplitude and moves that we've seen in prior situations. So that brings us into a 95% confidence that, or 5% confidence that we could trade above $103 a barrel through the third quarter. And then worst case scenario, we're talking about oil at above $165 a barrel in the current environment. I want to underscore those are tail risks, very low probabilities nonetheless, but we only get there if we see a significant, prolonged disruption to the flow of global crude oil.
We certainly don't see that right now. We appreciate your time, as always, sir. Stephen Schork there of the Schork Group. Thank you, sir. As we speak, crude takes another leg lower. We're down by more than 4% as we speak on Brent crude to 68.42. The turnaround in crude continues. Peter Chi of Economist called this story really well. Just writing moments ago, it's helped to re-establish deterrence and it's sent a strong message to all adversaries. Up next on the programme, we need to talk about the Fed Chair, Jay Powell. He is going to be facing down Congress over the next 2 days. That testimony begins in about an hour and 30 minutes' time. We're going to hear from Mike McFee for a preview in just a moment and get the thoughts of Torsten Slok of Apollo as well. Live from New York City, this is Bloomberg. Just getting confirmation from the Israeli side on this fragile truce in the Middle East. The Prime Minister's office in Israel saying the following: Israel to abstain from further strikes. The latest on that truce, a so-called ceasefire in the Middle East at the moment. For the scores, they look like this elsewhere. Equity futures on the S&P 500 firmer by 0.7% on the S&P. In the commodity market, crude taking another leg lower. At the moment, 68.75 on Brent. We need to get you some headlines. We can do that with Michael McKee this morning. Good morning, Mike.
Good morning, John. Well, the Fed has released Jay Powell's initial preliminary testimony to the House Financial Services Committee, and there's nothing really new in it. It basically repeats his statement from last week's post-meeting news conference. He pushes back against the idea of imminent rate cuts, although he doesn't mention him by name. He says the timing of the cuts will likely depend on what Donald Trump does. Policy changes continue to evolve, Powell says in his statement, and their effects on the economy remain uncertain. Increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. He says the best way to avoid that outcome is to know how long the tariffs will last, the size of the tariffs, and ultimately on keeping long-term inflation expectations contained. And he goes on to say, for the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. It sounds like he is standing against the Waller and Bowman view expressed over the last couple of days. The final notes from Powell I would mention is he says the economy remains solid. Uncertainty is elevated because of tariffs. Tariffs are pushing up inflation expectations, and the labor market is broadly imbalanced. And he says of the dual mandate, keeping inflation in check is probably the more important goal. They'll balance their maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. So it is not going to break a lot of ground, but we'll see what happens when the Q&A comes up. Obviously, Bowman and Waller's comments about a July rate cut will certainly get at least Republicans' attention up on Capitol Hill.
Well, Mike, let's get into that. We are well positioned to wait. Who is we? How many members of the FOMC stand behind that statement?
Well, right now it appears the majority do. We heard from Raphael Bostic overnight in a Reuters interview saying he still thinks one rate cut at the end of the year is the most likely. And pretty much everyone else who's spoken, besides Waller and Bowman, have suggested that they need more time to know what's going on. We did hear from Austin Goolsbee yesterday saying that if inflation continues to fall, maybe we get on with it, but he didn't put a time frame on it.
Mike the Key with the latest. Mike, thanks for that, sir. To extend the conversation with us around the table, Torsten Slok of Apollo. Torsten, good morning.
Morning.
There's the testimony. We'll get the Q&A a little bit later at 10 a.m. Eastern Time. We are well positioned to wait, are we?
Well, so let's take stock of where we are. Just last week at the press conference, Jay Powell said he expects a meaningful increase in inflation, and he said he didn't know anyone who didn't expect a meaningful increase in inflation over the next several months. And now we have Mickey Bowman and Chris Waller saying in the last few days, well, maybe we could already cut in July. It was, for both of them, contingent on not seeing that rise in inflation. But it is highly unusual that you have this public debate about should they be cutting in September, should they be cutting in July, especially when you take into account that this Friday, the consensus expects year-over-year inflation to go up. And next week, on Thursday, the consensus expects the unemployment rate to also go up. So that does bring you back to where does the FOMC put its weight? Does it put its weight on the fact that inflation is likely going to increase over the coming months, not only because of tariffs, but likely also because of the restrictions on immigration that have put some upward pressure on wage inflation? So there's plenty of upward pressure. Now oil prices are zigzagging a little here the past few days, but since the beginning of this month, oil prices are still up. So there's plenty of upside pressure on inflation that Jay Powell seemingly worries more about than other members.
The calendar matters. July 9th is the self-imposed deadline to have all these negotiations with trade partners and come up with the ultimate tariffs. The chairman saying this morning the ultimate tariff level will determine their impact. Will we have a better picture of that in a few weeks' time? And ultimately, when they convene in the next month or so, will they be in a position to say, you know what, we know now and we can make a call?
But that's why the jury is still out on this debate. Not only does monetary policy take 12 to 18 months before we begin to see the effects, but also, as you say, what are exactly the levels of tariffs here we're talking about? Are we staying at current levels with 30% on China, 10% on everyone else? Or are we about to see an increase? Scott Bessent said those countries who are not negotiating in good faith, they may go back to the level of tariffs we saw on Liberation Day, April the 2nd. So it could be that tariffs, we mostly expect that it will go down, but it could also be that tariffs potentially could go up. So that's why this debate becomes very, very important. And that's why we just don't know from a Fed perspective which of their FOMC members will end up being right. It could maybe be that Mickey and Chris Waller will be more right, but we just don't know at this point.
Let's say Jerome Powell goes to Capitol Hill, gets really grilled, and says, you know what, you're right. We should cut rates. We should cut rates next meeting. We should cut rates by 50 basis points. What happens on the long end of the yield curve?
Well, the risk here, of course, is when we saw the pivot party, when the Fed first started cutting, that we saw the long end go up. And the risk, of course, for the housing market is that we may also begin to see if the Fed ultimately starts to cave in to the view that, well, maybe inflation is not a problem, even before we know if it's a problem. The risk, of course, is that the long end may begin to say, well, then we want a term premium. Then we want some compensation for the risk that inflation may be allowed to be higher for longer. So the risk really here is, and I think Jay Powell will focus on this, we just don't know exactly what inflation will do over the next several months. So it's just a little bit too early to take the champagne bottle out and declare victory here over inflation, because he's worried that policy coming from tariffs, policy coming from immigration, and he might also be worried about oil prices putting upward pressure on inflation in the short term.
It's a really interesting debate around inflation. On one hand, either retailers and different businesses can pass along prices that they incur from the tariffs to consumers, and they can be fully absorbed, or they will take a hit to their profit margins, or some sort of combination of both. One thing about your work that's amazing is you really look at the granularity and what actually is happening on the ground. How much of the price increases have either come through have already been absorbed? What have we seen in terms of what different companies have actually been doing?
So different Fed surveys have exactly asked that question as a sub-question when they ask companies in the districts, are you passing cost on? And to what degree are you passing cost on? It varies a bit across sectors, but nobody is saying zero. Nobody is saying we're not passing cost on. Everyone is saying that they're passing some degree, some higher, some up to 80, 90%, some lower, 20, 30%. But the conclusion is exactly as you're saying, Lisa, someone needs to pay for the tariffs. Is it consumers in the form of higher prices? If it's not, and let's say that inflation does not go up, then I will really begin to worry about the S&P 500, because then the consequence is that earnings are going to take a much bigger hit, because then it's not consumers who are paying the bill for the ultimately higher import tax, but then it will be companies that will have to pay through lower earnings.
If you are just joining us, welcome to the programme. Moments ago, prepared remarks from the Chairman of the Federal Reserve, Jay Powell, as he heads into day one of two-day testimony on Capitol Hill. Mike McKee giving us some of the headlines from that. Mike, I want to bring you back into the conversation and talk about the calendar. At the end of July, July 30th, we get that Fed meeting, the news conference with Chairman Powell, and we're trying to figure out if we're going to know enough by then to make that a live meeting. Just go through the calendar for us, Mike.
Well, here's the problem, John. We get the PCE, as Torsten mentioned, this Friday, but it is going to show a year-over-year increase, according to analysts' forecast, because of base effects. And we don't get another PCE number until the day after that July 30th meeting. So CPI on July 15th is really going to be the only measure that we have. Now, it's the most detailed measure, but if you're trying to make a case for a rate cut, it might be harder to do without more backup. So for Waller and for Bowman, it's going to be kind of a difficult argument to make in there. Also on July 9th, as you mentioned, in theory, we get the latest tariff numbers, and everybody's going to have to work through those to figure out what that's going to mean for inflation. So even though we've got some people talking about the possibility of a July rate cut, it looks like still a very hard hill to climb.
Mike McKee, thank you, sir. Torsten Slok of Apollo. A few final questions for you. Let's start with this one right here for the Federal Reserve. July 30th. Some people think that's too soon. Others say we can take some comfort from the inflation data over the past few months. Is it signal or noise, the downside surprises we've had over the last several months?
See, and if we really back up and think about what's going on, this is a stagflation shock. Inflation is going up, which says the Fed should be hiking. Growth is slowing down, which says the Fed should be cutting. So where are they going to put their weight? Do they like apples? Do they like oranges? Are they going in the Taylor rule to put more weight on inflation and say, well, we got to keep rates higher? That's clearly what Jay Powell is saying. And that's, of course, at the moment seems to be the baseline, at least from the press conference last week. But at the same time, if growth is slowing down and if we are really unlucky and growth slows down very quickly, then, of course, the decision of keeping rates higher will turn out to be a mistake. So that's why the textbook does not give you an answer to a stagflation shock. And given we have a stagflation shock, stagflationary impulse coming from tariffs, stagflationary impulse coming from restrictions on immigration, including deportations, and also a stagflationary impulse coming from higher oil prices. All those things really complicate the decision of where do they put their weight on slowing growth or rising inflation.
What will determine the response to that is how long-lived either the stag or the inflation actually is.
Exactly.
And on the inflation side of things, how instructive is the labour market right now? Suggesting that maybe look at the labour market, it's weakening up somewhat. I don't see that as a source of inflation, and therefore I can't make a strong argument for this inflation spiralling and getting out of control.
That's true. So that's why there is certainly a case to be made of that this inflation spike is transitory. Of course, as we know from when they said that last time, they're probably very reluctant to use those words. But I do think that the conclusion is, to your point, the consensus does expect that inflation by the end of this year will be higher than where it, of course, is today. So that's why if we have 3-6 months ahead of us with some upward push in inflation, the risk is that companies will view this just like they did in 2021-22 as a chance to say, well, maybe we need to think about pricing, and maybe therefore that you could have risk that inflation does become more ingrained.
Is there anything that you could see that would make you rethink the idea of stagflation? Think that maybe things are better than you're currently making them out to be? I was looking at Nathan Sheets over at Citigroup saying one thing that has just surprised him again and again is the resilience of the U.S. economy and the fact that it has been able to absorb all of these shocks again and again.
And that is absolutely correct. It is impressive how well the economy has behaved so far. But that being said, the consensus still expects the unemployment rate to go up on Thursday next week when we get the next non-farm payroll. So the consensus is still saying, yes, the economy may be strong, but the consensus still is saying we expect the labor market to weaken. And importantly also, with the restrictions on immigration and much less immigration, of course, coming into the country, we may also have the non-farm payrolls is now on the long-run average around 50,000. So that means that maybe we have a long-run level that we need to compare with that's also falling simply because immigration has changed so much from where we were a few years ago. So that's why the labor market weakening could both be structural in nature, it could also be cyclical. So it raises a lot of debates around, well, is the labor market weakening because demand is weakening, or is the labor market weakening simply for the structural reason that we have less immigration than we had before?
Just quickly, 50. We might have to get used to 50,000 on payrolls Friday.
Absolutely. Because if you take the demographics, remember there was the paper by Watson and Edelberg from the Hamilton Project that they basically showed at Brookings that under Biden we had strong immigration that meant that non-farm payrolls was roughly around 200,000 every month.
Yep.
But now we have literally border encounters are really running at a basically zero rate, and at the same time we have deportations, of course, running at an annual rate roughly around 1 million people to be deported by the end of the year. All that means the labor force is shrinking. That means that the number of jobs created in the economy is going to be dramatically lower.
Torsten, always thought-provoking, always enjoy catching up with you. Thank you, sir. Torsten Slok there of Apollo. Prepared remarks just coming in from the chairman of the Federal Reserve, Jay Powell, saying we're well positioned to wait, and also saying the ultimate tariff level will determine their impact. Of course, we still don't know the ultimate tariff level. He's going to face a little bit of a grilling on Capitol Hill later this morning, first in front of the House Financial Services Committee, led by Chairman Hill, French Hill of Arkansas. So look out for that later at about 10 a.m. Eastern Time. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. Senate Republicans are coming around to the $40,000 SALT cap proposed by the House in President Trump's tax package, but they want to lower the income threshold. The SALT provision is one of several holdups for the bill. Other issues include Medicaid cuts and green energy tax credits. Republican leaders hope to pass the bill by July 4th. Meanwhile, NVIDIA CEO Jensen Huang sold over $14 million of NVIDIA stock over 2 days. It's his first transactions under a plan allowing him to raise cash without spooking investors. According to our Billionaires Index, Wang is the world's 12th richest person with a $126 billion fortune, which is made up almost entirely of NVIDIA stock. And Starbucks shares have been volatile this morning, but are currently up higher as the company disputes a report that it's considering selling its China business. Caixin Global reported that Starbucks held talks with over a dozen potential partners, including 2 private equity firms. But Starbucks says it's not considering a full sale. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the programme, setting you up for the day ahead, we'll catch up with Troy Gayeski of FS Investments on signs of economic resilience, if there are any. Where are they? And we'll also catch up with Danny Berger to get you some single names, some morning movers going into the opening bell. Live from New York. You're watching Bloomberg TV. The Federal Reserve is well positioned to wait. The words of the chairman of the Federal Reserve, Jay Powell, going into his semi-annual testimony later on this morning. That kicks off at 10 a.m. Eastern Time. The price action going into the opening bell about 42 minutes away. Equity futures up by 0.75% on the S&P. On the Nasdaq, up by 1 full percentage point with some morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. There's been an absolute frenzy going on with stablecoin stocks ever since the Senate passed legislation helping to make it more mainstream, stablecoins, that is. Fiserv, one of those companies, it is up another 4.3% this morning on an announcement that it would be partnering with MasterCard to develop more stablecoin technology. So MasterCard also up 3%. The technology stablecoin, a real threat to MasterCard, to Visa, who handle payment systems. Uber also to the upside this morning in the pre-market trade. They have partnered with Waymo, and now if you are in Atlanta, you can order a Waymo on Uber's platform. Uber trying to position itself to Wall Street to say, hey, we are going to be the platform because of our huge customer base, because of our name recognition, that we will offer this type of technology. Again, it's only the second city that they're offering it in, but with that launch this morning, shares are up 3%. Finally, wrapping things up this morning with these movers on KB Home that reported earnings after the bell yesterday. It had lower profit, lower sales, also cut its full year outlook. Again, those shares down 1.5% in the pre-market. It's an affordability issue that the CEO flagged with rates still high, housing prices still expensive, but the CEO also adding in that consumers were delaying big purchases because of geopolitical uncertainty and macroeconomic uncertainty. John.
Danny, thank you. It's tough for housing, that's for sure. Their stock is down by 1.5%. As we count you down to the opening bell, here's the trading diary, not just for today, but also the rest of this week. Today, the NATO summit is kicking off. 10 a.m. Eastern time, we'll get consumer confidence. Plus, Fed Chair Jay Powell testifying before the House Financial Services Committee on Wednesday, day 2 of the chair's testimony, this time in the Senate. Thursday, US GDP plus another round of jobless claims. Friday, core PCE and UMich sentiment. As world leaders gather at the NATO summit, geopolitical tensions continue to soar over the past few days. Annmarie joins us now for more. Annmarie, soaring through the weekend, de-escalating this morning.
Right. This has been a week of escalating to de-escalate, especially from the U.S. perspective. But this is going to be a very interesting NATO summit because the president is clearly coming in hot. He's really blowing off some steam this morning. He seems very annoyed and frustrated with both Iran and Israel. The fact that this is right now what you would consider a very fragile ceasefire, and this is what the concern is amongst allies, that this is very vulnerable right now for the region. The president is going to be met with really two different viewpoints here in Europe. You have France's Emmanuel Macron yesterday talking about the fact that he thinks the strikes from the United States on Iran are illegal, even though he doesn't want to see Iran have nuclear capabilities. And then you have someone like Friedrich Merz, the new German chancellor. Both of these men wrote in the FT piece today, but they clearly disagree about what is going on in terms of Iran. Merz had to say that he thinks Israel's doing the dirty work, and he says he shouldn't have an opinion because he really thinks that what the United States and Israel is doing is useful in terms of making sure they degrade Iran's nuclear capabilities. So what is going on in the Middle East is certainly going to overshadow this NATO summit that we're also, the president says he will get his exact definition, his words, speaking to reporters on Air Force One when it comes to Article 5. And for European allies, they want to also talk about another potential ceasefire, Jonathan, and that's what's going on this continent with Russia's invasion of Ukraine.
It'll be a fascinating few days over in Europe. Looking forward to your coverage, Annmarie. Thank you. Joining us now to build on some of this, Troy Gayeski of FS Investments. Troy, welcome back, buddy. It's always good to see you. Plenty of volatility in international relations. How much comfort can we take from the so-called resilience of the economic backdrop at the moment? Just how resilient are things?
Yeah, so I think that, as Torsten was saying before, and in your last interview, what continues to surprise people, particularly those with a more bearish bent on, whether it's 2022 and the tightening of financial conditions or obviously the threats from tariffs recently, is the fact that the U.S. economy, right, it's evolved over the decades to be much more of a service economy. We have a lot less sensitivity to trade than other economic blocks across the world. And net, when imports end up being reduced and exports either stay stagnant or reduced by less, you end up with better growth over time. And so if you drill down the numbers, like you think of consumption at the consumer level, obviously the labor market's weakening, but it's still relatively robust, particularly given the stress in the system from the trade war. And then you think of business fixed investment. Remember, one of the greatest things this country has going for it is the massive investment that's going on in AI and data centers. And so even with federal government spending cuts, which looks relatively unlikely in the short term, it was always very hard to get to a recessionary outcome. And now as we're getting more clarity on the fact that tariff risk is receding at least slightly, it just looks like a very unlikely scenario. So when you think about what that means for assets, it means even though equities are very expensive, there's more liquidity in the system today than there was pre-pandemic, M2. You still have supply of equities being sucked out of the market every year through share buybacks, which dwarf IPO volume. The trend for equities is still higher. And then in terms of the yield curve, it looks like we're due for another period of steepening as the Fed eventually starts to cut in the back half of the year. So, very interesting dynamic environment, but I think people tend to overestimate recession risk whenever there's any type of endogenous or exogenous shock.
Troy, just on the rate cuts, we'll hear from the chairman later on this morning. Are they the right kind of rate cuts? Are they the rate cuts that come because inflation's coming in or because there's something bad going on in the labour market?
Yeah, well, it's a little bit of both, right? As we were discussing before. So if you think of inflation, obviously the inflation data recently was incredibly supportive. And that's one of the reasons why, if you looked at annualized monthly annualized growth rates of real income, which drives consumption, which drives the consumer's ability to consume, you're at a 6 to 8% annualized number, which is really, really stunning. So prior to tariff implementation, very, very good news. Obviously, there's going to be some noise, slightly higher inflation in the short term. But the labor market had to weaken from where we were in 22 and 23. You can't run an economy where you have 2 job openings per unemployed person and expect inflation to get to 2 to 3%. So the labor market's weakening. That will give the Fed plenty of cover to cut at the end of this year. Somewhere between 50 and 75 basis points. From our perspective, makes a lot of sense. Enough to support the labor market, not enough to set off another round of inflationary pressures and cause the market to over-obsess over that.
That last point's the important point. Troy, always appreciate catching up. Troy Gayeski there of FS Investments. Looking ahead to the labour market later this week, Lisa, claims 243. The survey, the previous number 245, is something that's rattled Neil Dutter and others over the past few weeks.
If you look at the trailing average, the 3 and 6 month trailing average of jobless claims, they've been trending up to some of the highest levels that we've seen going back to the direct emergence from the pandemic. This raises some concerns for people. It is a reason why they do see cracks forming, even if they aren't obvious and glaring in any kind of material way.
Hard to fight this market at the moment, isn't it? Equities just keep grinding higher.
You know,
credit spread's still tight.
This has been a confounding market that is numb to a lot of the headlines. What is the biggest risk? Is it inflation, or is it a weakening economy, or is it some sort of pairing of the two? And that is still the debate, and it has been for the past couple of months.
Over the past few weeks, it's been the risk of missing out. The fear of missing out. Equity futures grinded higher again by 0.7% on the S&P 500. Will those moves give way to anything else? Crude, massive turnaround over the past few days. We've gone from the 80s to the 60s. We're down by almost 4% so far this morning. WTI, 65.94. Brent crude, 68.77. Coming up tomorrow, Greg Dacko of EY, former Chief of Staff to VP Mike Pence, Mark Short. We'll catch up with Alicia Levine of BNY Wealth and Matt Hornback of Morgan Stanley. Live from New York City this morning. Good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.